And welcome to the 13th meeting in 2014 of the Finance Committee of the Scottish Parliament. Could I please remind everyone present to please turn off any mobile phones, tablets or other electronic devices. We've received apologies today from Michael McMahon. However, Michael today is being replaced by Ian Gray. And I'm just wondering, Ian, if he has any declarations to make.
Nothing to declare.
Nothing to declare, thank you. Our first item of business this morning is to decide whether to take item 3 in private. Are members agreed?
Yes.
Members have indicated their agreement. Our second item of business is to take evidence on Scotland's public finances post 2014. I therefore welcome to the meeting Dr Angus Armstrong of the National Institute of Economic and Social Research, Professor Joe Armstrong of the Centre for Public Policy of the Regions, and Jim and Margaret Cuthbert. Committee members have copies of written evidence submitted by our witnesses, so we'll go straight to questions, and is normally the case, the Finance Committee, as I'm sure you all know because you've all been here before. I will start off with some questions and I'll open out the session to colleagues round the table. So, where do we start? Well, first of all, I have to say that really interesting and impressive submissions from all of you, which were incredibly diverse. Actually, in reading these submissions, I wondered sometimes we were all talking about the same kind of subject matter because the kind of conclusions drawn and the way forward, etc., was so diverse. So, let's start off, and I'm thinking, where should we start? I think I'll start, for no particular reason, with yourself, Joe, actually. All I was going to ask, first of all, was in terms... No, sorry, I should have said that when I ask a question to Joe, if other witnesses wish to then comment on what Joe has said, please indicate to me and I'll be happy to let you in. And of course, when I ask other members of the panel questions, the same rules will apply. So, Joe, just in terms of your own fascinating submission, you talk about... in 2012-13, Scotland's share of the UK's debt interest and loan payments associated with historic debt, about £4 billion. This is expected to rise to over £6 billion by 2018-19. And you have argued in your paper for Scotland assuming a low or zero share of the UK's existing debt. Now, obviously the Scottish Government has indicated its willingness to accept its share of the debt. I'm just wondering if you can talk us through the kind of logic to your paper and why you've kind of come to the conclusions drawn in it.
Okay, yes, and clearly the Scottish Government has indicated that, so it wasn't an attempt to try and say they were wrong. It was an attempt to say, beyond a yes vote, there will be a whole host of negotiations. One aspect of that might be around Scotland's share of debt, and it wouldn't necessarily be walking away from debt, but it would be about an agreed, negotiated position, accepting or receiving a zero debt opening position. The reason for that was the finances that Scotland would face beyond the referendum in the short term at least don't look terribly positive because of its onshore fiscal position being in a deficit, and with the projected official set of statistics or projections for North Sea tax revenues, that deficit doesn't get eliminated. So if you started with a zero debt position, you then didn't have to take on your debt interest costs, and that would actually then release or produce a surplus for Scotland. We thought that was worthy at least putting out there as part of the debate about what a negotiated settlement might look like.
Convener, I apologise, I've got a small fault with the sound system. Can you give me 30 seconds and we'll clear it? Yes, sorry about that. Sorry about that.
Oh, 30, at least it was 30 seconds. Okay, then, Professor Armstrong, or sorry, Dr Armstrong, or Jim Margaret, you any comments to make on what Joe's said in our paper?
Yes, I mean, you will have seen that we also cover the question of what Scotland's initial debt might be in our submission, and indeed we take a different line that a Scottish negotiator might start from actually looking at what Scotland's oil fund might have been had Scotland been independent since 1980. And the starting position by such a negotiator might be to look for some recompense for the 150, possibly billion oil fund that Independent Scotland might have been enjoying. But I mean, leaving aside that negotiating position, even before one gets to that, there is a question about what the size of the current debt interest payment actually is. Because here we come to the thorny issue of quantitative easing. Now, actually, a third of UK debt has been quantitatively eased, and the interest on that recycles straight back to the Treasury.
I realise that's in your paper, and I'm quite happy to discuss that, but I'm just wondering, so we don't end up wandering all over the kind of place, I'm just wondering if you can kind of comment on your views on Joe's position in our paper, and then obviously I would allow the other panellists to comment on what you thought, because we've got a lot of people obviously on the committee, we'll have a lot of questions we want to ask, so I think I don't want to drift on to quantitative easing at this point. I want to try and focus on the specifics of Joe's paper on the point I asked, if that's possible.
Yes, I think it is relevant, because if you're looking at the starting position as, you know, the common thing is to take the GERS deficit and project forward from that. And that effectively is what Joe is doing. And what I'm suggesting is because of quantitative easing, the GERS deficit is overstated by something like 0.8% of GDP. And it's also relevant when you look at the side of the current GERS deficit, that it implicitly assumes, for example, that Scotland is spending 2.2% of GDP on defence and spending 0.5% of GDP on international services. Now, an independent Scotland would certainly, or could potentially take a different view on those. I mean, Ireland spends 0.6% of GDP on defence, New Zealand spends 1.1%, Denmark spends 1.4%. So when you add all these things up, the current GERS deficit potentially overstates the position of an independent Scotland by something like 2.3% of GDP. And that's relevant to the sort of starting position in Joe's argument.
Thank you for that. Margaret, sorry.
My point is also about the baseline that Joe has used. As she said there, the onshore fiscal deficit looks poor at the minute, and therefore that's formed the basis of her looking at whether we would take on debt. And actually, while I thoroughly agree with her that we have to look at not taking on debt, at the same time I think the onshore fiscal deficit is exaggerated for the future, insofar as at the minute, if you look at the way in which we collect taxes, particularly corporation tax, as you all know, the UK is particularly poor at actually collecting the tax. And as well as that, the actual taxes that we have in the UK are not necessarily the ones that are best in sync with what we should be collecting in Scotland. And so if we actually change those, our onshore fiscal position could be considerably improved. Okay. We'll go into that in the detail.
Dr. Armstrong.
I was surprised when I saw the CPPR's research bringing up this hypothetical, I think, example. It was sort of outlining, trying to illustrate an argument, I think was the point of it, is how I read it. But Joe can obviously explain much better the motivation for it. I think that most people think that on all sides, and all economists think that a fair and equitable share of the debt is probably the right way to proceed. Zero, I think most people find challenging as meeting that criteria. I think that there are broader issues. It's hard to see how that would be, I mean, it's extremely hard to see how that would be agreed. One side, if it was to be a walk away, it's not that easy to walk away from debt. I mean, there's still a lot of claims against countries that walked away 20 years ago from their debt. The debt stays. It has to be agreed on both sides that this is an appropriate appropriation. Then you have the much wider context of things like Europe. You know, there's a large discussion about debts in Europe. This would be an extraordinary precedent to start setting. So I can understand that it was put out there as a hypothetical case, but as a serious proposition, I don't agree with it as a reasonable proposition.
Okay, thank you for that. Now, I'm going to turn to yourself because I was...
Possibly
Oh, sorry, of course you can respond, yeah.
Because there's two things I think important. One, it is hypothetical, but it is in the context of, in a negotiation, all things are on the table, I think, and zero debt does fundamentally change Scotland's fiscal outlook in the short term. And secondly, whilst there will be opportunities to change tax rates and bases and types, the current trend, and that's all we can work on at the moment, is the short-term trend out to about 2018-19, is that Scotland will have an onshore fiscal deficit that is quite large and is not eliminated as a consequence of North Sea tax revenues. So although in the longer term all bets are off and opportunities might exist, the short-term trend, what's in the pipeline, what we know now, irrespective of the vote in September, is that Scotland has to deal with a higher fiscal deficit than at the UK level at the moment.
Okay. Now, Dr Armstrong, I'm just going to turn to your paper next, actually, because under the section borrowing, there's some fairly alarming figures, I have to say, in here, which I found difficult to comprehend. I mean, you've talked about the potential a clean break with the Scottish Government paying the UK Government an astronomical £102 billion in cash in 2016-17 as being one option, the other being a kind of IOU whereby Scotland pays its share. But you talked about under the IOU option, this would issue a share of maturing debt plus interest on the IOU. Not really sure why we would pay that if we're paying effectively in parallel, which you said basically this implies a first-year payment to the rest of the UK of around £23 billion repayment plus the IOU. I mean, to me, this seems an extraordinarily large sum of money. I mean, would the maturing debt not effectively be reissued? You know, I mean, are you seriously thinking that the UK is going to pay off £224 billion in that year and we're going to have to stump up 23 billion of that? How is that realistic or even possible in any way at all?
Well, first of all, you're quite right to say they're very big numbers. They are very big numbers. Government debt are extremely big numbers. So while these might look like eye-watering numbers, they are, what, 8.4% of an agreed amount of debt. So first of all, we have to have an agreed amount of debt. So we have taken, and we can argue about which one's the right number. That's fine. We've taken 140-odd billion as a Maastricht, the gross debt, based on a population, which we think is an equitable share. It's been used in the White Paper and various other places, and awarded Scotland the geographic share of oil. So that's the basis of getting to this sort of 140 billion. Now, the idea, so first of all, that 140 billion after independence is what will be an independent Scotland's share of the existing UK debt. So that would in fact be a debt to the rest of the UK government, because the rest of the UK government has accepted ongoing liability for the debt that's issued. So the question is, how does that get repaid? Well, to repay it, either Scotland has to hand over, reduce some of its assets, which is one possibility, or it has to raise its own debt in order to repay the debt with the rest of the UK, which is the IOU option. So, to be clear, why does 140 go down to about 100 billion? Well, that's because the 140 is spread over a number of years according to the yield curve, the date at which bonds have been issued. There's a big difference between owing 140 billion in 8 years' time and having to pay 140 billion today. So the discount factor reduces that down to about 100 billion in cash terms today. So one option is to pay it in cash terms or reduce your assets in cash terms. The other option is to pay it over time. Now, that means 8.4% of each of the bonds maturing over the yield curve. We know that there's about 225 billion approximately maturing in the first year of government debt. That's of the existing yield curve. So we have 8.5% of that, which is about 18 billion. That's only covered 18 billion of the 140. So you have the other 122 billion outstanding. That's what the interest is being paid on. The rest, which is not being paid off. So the 8 billion, which is 8.5%, sorry, the 8.5% of the maturing one-year debt is approximately 18 billion pounds. That money has to be repaid in the first year. The rest of the loan, the rest of the IOU, is still accumulating interest. You still owe it. So you've got 140 minus that 18, so you've got 122. That's what you pay the interest on. And if you take a government bond yield, government bond rate, say the UK rate, that's fine. That comes to about 3.5. So then you've got the 18 plus the 3.5 plus whatever fiscal deficit you're going to have. And I'm sort of not reading out the figures, so forgive me if I'm rounding numbers. But that's how you get to these sort of numbers, which are indeed very large.
Saying that the UK is going to pay 224 billion off if
No.
Scotland's not independent?
No.
Then?
Well, first of all, what the UK will do
That year.
No. The £224 billion in first year, those bonds holders will be repaid. Absolutely unequivocal. So the answer to that question is yes, they will be repaid. Can I finish? So one moment, they will be repaid. The question is, how do they get repaid? The UK government will issue bonds to repay them, the same as the Scottish government would issue bonds to repay its share of that 224.
Exactly. So how do we end up with a net having to cough up £23 billion, you know, in a year if we're reissuing bonds the same way as the UK government would be? I mean, it seems to me. I mean,
they're the bonds you'd have to issue.
I mean, Joan, her paper was basically saying, you know, that that Scotland's share of the UK debt interest and loan payments associated with historic debt was around £4 billion, expected to rise to over £6 billion. So surely that would be a more realistic figure once this kind of shenanigans had taken place.
Now, the big difference is repayment of existing principal. Okay, so if I have a mortgage, I can have an interest-only mortgage, or I can also pay off the mortgage, the principal. And in these calculations, we're assuming the principal is going to be paid off in line with the existing maturity of UK debt. Now, of that existing maturity, 225 for the UK government matures in 1 year. 8.5% of that is about 19 billion. That is the principal, the share of the principal that you would be repaying. Okay?
You've said all this, but I mean, surely then the net amount they would actually pay after reissuing of bonds, etc., would mean that we wouldn't actually have to be faced with paying £23 billion.
So what this is saying is the amount of bonds an independent Scotland would have to issue in order to meet its obligations. Okay? So it would have to issue bonds to cover the 8.5% of the 225, so that's about 19 billion. It would have to issue bonds to cover its interest obligations on the rest of it, on the non-outstanding debt, plus the deficit. I mean, in those numbers, the 25 or 23 billion, which is quoted in the papers, there was no deficit, which I don't know what the deficit is going to be in 2015-16, but I think it'd be a brave man assuming it was zero.
Okay, I didn't see any really reference to the kind of bonds, etc., as we went on, but what you did actually say is under the right of repayment option, an independent Scotland would have a high debt burden, although lower than the rest of the UK.
Yeah.
Okay.
That's true. So the rest of the UK's debt burden, so debt burden, just for clarity, is the ratio of debt to GDP or GNI, if there's a difference between GNP and GNI. That's the resources of the domestic economy, the amount of debt divided by the resource of the domestic economy. The debt burden of the rest of the UK with Scottish independence rises by about 10 percentage points. So it's quite a big difference for the rest of the UK. There's quite a big impact. So that statement that Scotland's debt burden, would be below the rest of the UK is true. What is high? Well, high is a fairly relative term, but I think around 80% most people would consider high. Of course, today, there's a lot of countries that have got high debt burdens, but compared to comparative countries, I think 80% of the debt ratio would be perceived as a high. Not necessarily, you know, punishingly high, but certainly high, but lower than the rest of the United Kingdom, significantly lower.
Do any other members of the panel wish to comment on this? Jim?
Yes. I mean, I think it's important. I mean, Dr. Armstrong mentioned the negotiating position in debt on the white paper. And in fact, there were two, as I recall. One was that the Scottish Government might take over a population share, and one might take over a share of debt based upon a calculation of historic deficit. Now, I hold no brief for either of those figures, and in the paper that we did on debt, we took issue with both of them. And so I'm not seeking to, in any sense, defend those positions. And I think if one could put oneself in the mind of the drafters of the white paper, one might imagine that they were operating under the terms of the Edinburgh Accord, which was effectively that this would be conducted, the whole business would be conducted in a gentlemanly fashion, and the gloves would not come off. Now, the gloves have unfortunately come off because of the negotiating position that the Union side has adopted on currency, for example. So, my own view would be that the positions in the white paper on debt are flawed and untenable, and that the way it should be approached would be in terms of the principle set out in the Vienna Convention, which would be looking fundamentally at the principle of equity. And the judgment on this will not be taken by economists, despite what Dr. Armstrong said, but will depend upon political judgments depending on relative bargaining position and on what the public's perception is of the equity position. And the equity position there's a strong case for arguing, a negotiator could have a strong case for arguing that Scotland should be starting making a claim for compensation of around 150 billion, and that the negotiation should move on from there. And in light of that position, the idea of a zero debt position for a newly starting independent Scotland is not at all unfeasible.
Okay, I'm going to ask you about that in a minute, but I'm just wanting to ask Joe what your comment is on the kind of figures that have been used by Dr. Armstrong in terms of his ESR report.
If Scotland takes on its share, whatever that figure is, given the current fiscal outlook, to be able to pay back its obligations, it will have to raise debt. So whilst there might be a net-net position that we end up paying roughly the same interest rate, although indeed that's even questionable, it will have to raise debt and it will have to pay back based on the current UK government's obligations to pay back to the money markets. If it didn't follow that format, then it would start to cause it problems with its ability to raise its own debt in the money market. So there's an element of, whilst you don't like these big numbers, that's the reality of taking on that share of debt. A smaller share of debt, the amount of debt it has to raise will be less, but nonetheless, taking on a share of debt in a world where we've got a fiscal deficit means it has to raise debt of its own size, and those numbers are large.
Of course, Professor Armstrong.
Can I just,
Dr. Armstrong.
Letter
of Armstrong.
It's quite all right, no problem. There are other options. An option we've stressed, of course, is that you can reduce debt by transferring assets. And as politically difficult as this might be, having such a large and volatile asset, it might make good economic sense for both sides to transfer this. So, you know, what we're trying to say is, yes, these numbers are big based on what Jim has said is, you know, this notion of equity, but perhaps we should look at also what are the other options which don't seem to get such an airing.
Yes, I mean, as you said, we propose a debt for oil swap which should leave both sovereign nations better off. That idea actually offers a real free lunch.
Yeah.
You know, which I'm interested in. I mean, there are other assets, of course. I mean, for example, the UK defence assets are about £92 billion. Scotland's share would be about £7.75 billion. Only about a fifth of that's within Scotland. So there's would you advocate, for example, that some of that could be used perhaps to offset against Scotland's debt?
Yeah, I think that all of the assets have to be taken on a case-by-case basis. And it's a question of which assets are sort of fixed to location. So you couldn't move a motorway, for example. But you could, some of the warheads or defence, you know, like a ship, for example, which is obviously mobile, that could be moved and traded separately. So I think it has to be looked at on a case-by-case basis. And oil is one of those things that's sold onto world markets, which is why it's actually a very useful asset that is not actually specific to the location. You sell it to offshore, to international markets, whereas other assets like motorways obviously are dependent on the location. So each asset you'd have to go through. I think it's perfectly reasonable that some of the military assets, which are mobile and not specific to a location, would be part of the negotiation.
And will you kind of teased us a wee bit in your paper, be talking about the kind of, oil for debt swap? We haven't really been into it in any great detail. How would this actually work? So
the reason, well, we actually put this out, it was part of a paper in last September, October, not sure which one. So the idea is that countries which have a smaller set of assets, having an asset which is highly volatile can be quite problematic to manage. Whereas for bigger countries, 11 times bigger, having that volatility is easier to manage. It's just the nature of being bigger, that's all. It's not to say anything about debt ratios or anything else, it's just part of being a bigger nation. And so if both sides could agree a fair value, the expected value of what these oil reserves are worth, the tax value or even the expected value, if you could get an agreement of that, where would that volatility be most easily managed? In the smaller country or the bigger country? And the answer is in the bigger country. That's assuming you can get to a fair agreement, a fair conclusion about what it's worth. And so transferring some of that volatility to the bigger country means that the smaller country would benefit because they don't have the difficulty of dealing with this, and the bigger country, which doesn't actually have that much difficulty dealing with the volatility, presumably would be willing to pay a slightly higher price. And so that price in the middle would be the free lunch, because actually you're doing something which is better suited to having it organized this way. Now that presumes, and I accept that this is the major presumption in it, that you can agree what the stuff is worth.
I want to let colleagues in soon. They've been quite patient. I'm going to let John in with a brief supplementary and then Margaret, and I'll ask one final question and open up to committee members.
Yeah, yes, it was just to ask a little bit more on that exact point. So you would be losing the volatility, the smaller country would be losing the volatility, but you would also therefore you'd be losing any potential upside. So if the price did go up over time, that would have been a bonus that you would have then have lost.
100% correct. So you lose the upside and the downside. You get cash today, and so the cash today, depending on what your belief of the tax revenues, the discounted value of the tax revenues is, presumably that count against the debt immediately. And so with one step, the debt profile of an independent Scotland would look completely different, totally different. And we're dealing with a different proposition then.
Margaret.
I think exactly on that point that I wanted to comment. You would lose the upside. In fact, if you look at the OBR's figures on oil and look at Alec Kemp's figures on oil and the one given by the Scottish Government on that they base on Alec Kemp's figures, there's a huge difference between what one expects as the return from oil over the next up to 2040. And so we're starting very much with different ends of the negotiating table as to what the value of oil is. And to my mind, this is just an oil grab that's being suggested by Angus on its way through. The other 2 points I'd like to make are on the assets and liabilities. I agree entirely that, like the Vienna Convention, you have to bring in what assets Scotland would like to take. And if you look at that, we're unlikely to be taking in anything like our population share of UK debt. And if at that point we say, well, no, there's a huge bit of debt that neither side actually wants, I suggest that goes to the mismanagement of the UK economy over the past 40 years. And I think oil is a very, very poor asset to take, much more because of its volatility, a much more sensible asset to take would, I agree with you, be defence and the high-speed train line.
The final question I was going to ask before I open up to colleagues is basically on the issue which you've raised already, Jim, which is this issue. You talk about debt sharing using the principle set down in the UN's Vienna Convention of 1983. Of course, the convention was never ratified. Now, when the Soviet Union broke up, none of the 14 new independent states other than Russia took any of the debt. It all went to Russia. But some of those countries, I mean, particularly some of the Baltic states, were effectively ransacked, I would suggest, by the Soviet Union. But prior to those countries becoming independent in the decades before that. But yet there was no kind of compensation paid. But you're talking about base of negotiation, principle of equity, and you've already mentioned that because Scotland, if it had become independent in 1980, would perhaps have an oil fund of around 150 billion, the UK should compensate Scotland for that. I mean, is there any... Surely there is no realistic possibility whatsoever of the UK agreeing to that or anything like it?
What we're talking about is the starting point in a negotiation, though, and we're also talking about our position in the Court of World Opinion, which is very important. There's a common talk that if Scotland didn't take on a share of UK debt, it would be regarded as defaulting. Well, that is a judgment which really it's for the Court of World Opinion to decide upon. And if Scotland has refused to take on debt because it's effectively been plundered of 150 billion, then that does not amount to a default. And in terms of bond markets, a debt-free country with strong natural resources is likely to be potentially a better credit risk than the rest of the UK, which is in a very dodgy budgetary position.
Now, Joe has pointed out actually that why start at 1980?
Absolutely. I mean, we actually discussed this in a paper we published with the Jamie Reid Foundation. It's referred to in the back of our paper. We discussed this question of why one might take 1980 as being a starting point, and we give some reasons in that paper why it's perfectly reasonable to start then. But actually, there's another reason which we don't give there, which is the 1979 referendum. And a Scottish negotiator could well make the point that in 1979, Westminster ignored a majority vote of Scotland for fundamental constitutional change, and from that point, essentially, all bets were off as regards the division of subsequent assets.
Okay, thank you. Dr. Armstrong.
Can I just, on this world opinion and the convention, this isn't the Congress of Vienna in 1814. I mean, Vienna, they passed a lot of conventions, right? World opinion, well, I'd suggest you look at the countries that have ratified this. It's hardly world opinion.
No, I'm not talking about world opinion regarding the Vienna Convention. I'm talking about world opinion as regards the world and market view of what a potentially debt-free independent Scotland would look like, and the reasons why they were debt-free and why it was reasonable for them to refuse to take over a part of UK debt.
Okay, well, in which case, far be it from me to bring up people who've got things so badly wrong, like rating agencies, but we know that S&P say what their guesstimate, based, I think, on 2013 figures, or maybe 2012, I'm not quite sure. Their estimate of debt to GDP for an independent Scotland, a hypothetical number, obviously. I think they have 77% debt ratio. So zero, you could also, well, there's lots of hypotheticals. In fact, there's an infinite number of hypotheticals. But in terms of world opinion, this convention it's more noticeable by the lack of any OECD countries. At least one rating agency, I haven't seen the others. I'm not sure they've actually specified what they think the parameters of an independent Scotland would look like yet. What they have said, what has been the debt share, we know from Czechoslovakia, as you pointed out, for many of the former Soviet Union states, there wasn't much debt actually. It was actually, it was very, very problematic. We know from Quebec's ultimately, the fact that they didn't split from Canada, we know what was being negotiated then as being reasonable parameters. There was about 4 measures. Affordability is the other way. Affordability sounds quite like equity. Affordability would leave independent Scotland, once you take into account the all share of GDP, with paying a higher share. I'm not advocating one versus another. I'm just saying that actually, if you look at what, say, Canada was considering as reasonable options, affordability and population were the 2 central cases, apart from what was clearly the interests of people who were arguing one side of the debate versus the other.
Yes. Joe, do you have any comment to make?
I think it just flags up the issue that says beyond a yes vote, the negotiation parameters are wide on certain outcomes, and we still have to fund current spending plans.
Okay, Margaret, the last point on this question, because you haven't talked on this question.
I think what Angus has said shows that everything is to play for. There actually aren't any proper examples from the past, so it's really a political game on that issue. But the one thing that he did say on the looking at the option that in fact Scotland might end up paying more if we did it in affordability shows very clearly a point that Jim made, that we are in a very good position after independence as far as world markets go, because they would indeed regard it as being capable of paying and being a worthy debtor.
Thank you very much. A really fascinating opening round, and committee members have been very patient. So therefore, I'm now going to open the session to them. The first person to ask questions will be Malcolm, to be followed by Jamie.
Apart from the 1980 question, I suppose the other factor that Jim and Margaret Cuthbert aren't taking into account is that relatively high levels of public expenditure in Scotland rather than the rest of the UK, which would be obviously a point that the rest of the UK would make in response to your proposal. But I know the Scottish Government is not supporting your position, and as far as I understand it, they're supporting the position which I thought was very helpfully explained and outlined in relation to debt and bond markets by Dr. Armstrong. And my first question was really a follow-up to that, because after his explanation of the situation that would pertain in terms of new borrowing, he says, our analysis shows that an independent Scottish Government would be likely to pay between 0.72% and 1.65% higher interest rates for borrowing at 10-year maturity. So I think this whole question of what the interest rates would be in independent Scotland is clearly very important and obviously pretty controversial as well. But what my question, I suppose, first of all, to Dr. Armstrong was he assuming some currency arrangements in those figures? I read another paper that he read recently about dollarization, and he made the comment that, you know, without a lender of last resort, well, in fact, he goes on, you actually say in that paper that interest rates would be even higher than you estimated in your paper last year. So clearly, even you are changing your mind about this. So I just wonder what those figures are based on, and particularly, do they assume any particular currency arrangement?
That's a very, very, that's a great question. So, very fair question. So the original estimates, which were put in our paper in, I think it's October last year, we very specifically based them on a calculation using all of the countries in the Eurozone between 2000 and 2012, trying to take out the crisis countries. So we tried to take account of that. Why did we use the Eurozone? Because at the time, the proposition we were testing is under a full or formal monetary union. So you had one central bank acting for all members. So under that context, the Eurozone was a very useful way of estimating this. So that's how what we based it on. So, you okay with? So the follow-up paper saying, actually, you don't have a central bank for all countries because the ECB clearly, the policy-making committee has a central bank representative from all the national governments, all with equal vote, who should, their mandate is to vote in the interests of the union, not in their own national interests. So it really is a shared central bank. Under that notion of a shared central bank, that's where we estimated those spreads. Now, if you're now discussing a different monetary arrangement, dollarization, that's a different type of central bank. You don't have that shared policy making on that committee. You're using somebody else's central bank. And so clearly some of those risks change. And that's why under dollarization, I would say that the estimate is more likely to be higher than under the first illustration, which was assuming a shared central bank. So there were two different examples.
So are you saying, therefore, that in your estimation, even with the monetary union, the borrowing rates would be higher, but they would be even higher if there was some other monetary arrangement?
So to be clear, under a formal monetary union with a shared central bank, the estimates that we had, 72 to 165, where the central point is 120 basis points, they stay. That's under that model. If you don't have that model, you have an informal currency union where you don't have a shared central bank. The interest rates, the spreads, are likely to be higher.
So in terms of the work that you then, basically my two questions, one is about interest rates and the other is about, obviously, the general fiscal situation. You say you've done this 10-year fiscal simulation, and Joe Armstrong's obviously done a lot of work on this as well, and you say that a newly independent Scotland would need to engage in more than 3% additional fiscal tightening over and above what the UK government is already proposing. Again, if you could talk a little bit around that, but does that also assume the monetary union situation, or how would it be different if it wasn't? That's it.
So in that simulation, we assumed a formal monetary union. So we assumed that spread of interest rates. And we took the Maastricht definition of debt as the starting point, and we completely hypothetically said, in 10 years' time, let's say you want to get down to a debt ratio of 60% debt to GDP. Now, you could quite reasonably say, that's not reasonable. Go for 80. Then you redo them, and you come out with new estimates. Go for 40. You redo them, you come out with new estimates. But on that number of 60, and we got the 60 from the Maastricht criteria, that's what you're supposed to have to get into Europe, to join the Eurozone, rather. On that basis, then a purely mechanical process of what sort of primary surplus do you have to run to get to that number would end up being a tighter fiscal policy than currently proposed by the UK government. It's a very mechanical exercise.
What does 3% mean in practice? I mean, I suppose it depends how many years you do it over, but what kind of fiscal tightening in any 1 year would that, could that involve?
Well, it depends on the how fast you want to do it. So you can either do it, so this assumes you do it immediately, and then if you take longer to do it, so you spread it over, 0.5%, over 6 years plus a bit for the interest that you're paying, then the amount that you're going to have to tighten eventually is going to be a greater figure than that. So it assumes you do it immediately and then keep it there.
If I could just broaden this out, I can't really ask too many questions because all my colleagues are champing at the bit. But just to bring in Joe Armstrong, I suppose, this rather intrigues me because I think Joe Armstrong has a similar analysis of the fiscal situation. But I suppose the paragraph I'm fastening on is, and this really interests me, why, we've talked about, I know, not having any debt option, and the context in which the Scottish Government has talked about that is, well, if we don't get the monetary union, then we'll say we're not going to pay the debt. So I suppose the question really is, why in that sense is the Scottish Government sticking with a monetary union if the alternative is no debt and presumably what you advocate, Dr. Armstrong, their own currency? I suppose, what are the really negative consequences of that? I mean, Joe Armstrong makes the point, such a bargaining position implies that the Scottish Government believes the long-term negative consequences of a separate Scottish currency or pegged to sterling without an official monetary and currency unit significantly outweigh the short-term potential benefits of starting off with no debt and a near-balanced budget. So I suppose what I'm interested in is what, perhaps Joe Armstrong can answer this, I mean, you floated the possibility of no debt, but in a situation where that wasn't negotiated, it was just something that happened because there was no monetary union. What would those negative consequences be? I mean, the Scottish Government must think they're pretty profound, otherwise that would be quite an attractive option, wouldn't it?
Well, it did seem interesting to us that we hadn't seen that as an alternative option, and again, I think it would be probably part of the bargaining, opening bargaining position post a yes vote. The obvious ones are transactions costs, so businesses trading with the rest of the UK will face higher costs if you're using non-sterling. If you're using sterling dollarised, then it's additional costs that the Scottish Government would have in terms of its reserves to manage any stresses and strains it have around its exchange rate policy. So those two effects, which we don't have numbers on, would be presumably more significant than the benefits of having a zero debt position. And
I'd be interested in Dr. Armstrong's position on that, because you don't think that the monetary union is good for anybody, but what would the consequences be then? Because you're assuming, does that mean you would just have to accept the higher interest rates that would result from that?
So if I follow, the idea of this zero debt, I mean, I really find this okay.
Zero debt, because you advocate, you're saying it's not in Scotland's or the rest of the UK's interest to have a monetary union.
Yeah.
So you think a separate currency would be better, but there must be negative consequences of that in terms of what you yourself have said about interest rates. Would there not be, or do you not see any?
No. Well, okay. Sorry. Now I've got the point. So in this, so it has to be in both nations' interest to have a monetary union. That's the pretty obvious point. A full monetary union. A full monetary union means a shared central bank. A shared central bank, almost by definition, means it's got to be in both countries' interests. Now, Professor Armstrong has quite rightly pointed out that there would be higher transactions costs to having a new currency. It's completely correct. I think that has to be put in context for the rest of the UK, because you have the rest of the UK's. You've got to look at it from their angle. You have to have both sides agreeing. The bigger cost of what happens if something goes wrong, and this is the sort of risk management approach to considering different exchange rates. So you're starting off with maybe a debt ratio. Let's take S&P as independent, 77% debt to GDP ratio. You've got deficits, as Professor Armstrong's projections have got, of deficits certainly out to 2018-19, which I think is as far as you go, out to 2018-19. You're using somebody else's currency. It's not unreasonable to ask the question of what happens if there's a big, nasty shock. These things do happen. What are your degrees of freedom, your room for manoeuvre? Arguably, they could become quite limited, and therefore a prudent and reasonable thing to do is to bring these things up at the beginning, where we're here now discussing these things, and say, what would actually happen in that situation rather than get there and then worry about it. And the costs of getting to that position, as you've seen in some countries around the world, can actually be extremely high. The costs of these sort of problems can be way more than transactions costs. And that's why we came to the conclusion we did. Under the conclusion that you're not going to have formal monetary union, then depending on what that alternative arrangement looks like, if it's something like dollarization, which I think seems to be the converging position as far as I can see, then would that mean that an independent Scotland would pay higher interest rates than the midpoint of the range we estimate is 120? Then that, yes, I think that is the case, that the risk is the rates are higher than that.
Okay, that's fine, thank you.
Okay, thank you. Oh, sorry, yes, Jim, you know, got a chance to come in.
I'd like to clarify, first of all, a point that Malcolm made when he said in his initial remarks that one thing that we neglected was the relatively higher levels of public expenditure in Scotland at present. Yes, indeed, public expenditure levels are relatively higher in Scotland, but in the calculation of the 150 billion, the existing levels of public expenditure are taken into account. In other words, we're fully bringing into that the level of public expenditure in Scotland funded through Barnett. So that is allowed for in calculating the 150 billion. Two other quick comments on the discussion. One is that point I've already made, that in the existing GERS deficit, there is something like 2.3, 2.5% of slack. First of all, arising from quantitative easing. Secondly, arising because of the implicit assumption that Scotland has a 2.2% of expenditure on 2.2% GDP expending on defence, which an independent Scotland could well not, might well choose not to replicate that level. Similarly for overseas aid. So there's a level of slack there. And the other thing about the overall discussion is that it's been conducted in the context as if the UK position was a risk-free position. Now, in fact, the fiscal position of the UK is extremely dodgy. If you think of the UK, an analogy was made by Stephen Nickel of the UK as being a large bank, it has assets and liabilities out of the range of any other comparable large international assets and liabilities out of the range of any other comparable country. International assets and liabilities of the UK are 700% of GDP and growing at 8% per annum compound. That is not a sustainable position. So there's a major risk of a systemic crisis, a repeat of systemic crisis in the UK economy within, let's say, the next 8 to 10 years. We should not abstract, one cannot abstract the discussion of Scottish independence from the consideration of that kind of risk.
Briefly, we haven't got time for a big discussion, and I'd like to see your figures, but in general terms, if you look at the figures over the last 3 decades, the extra revenue from oil, it's balanced off by the extra expenditure in Scotland. So I don't understand how you get such a big differential from that.
Well, I'm happy to give you a note on that, but the extra expenditure has been taken into account, as indeed it has in the independent calculation done by the Fiscal Commission and done by McIntyre Kemp, who came out with the conclusion that were entirely consistent with the conclusion that we were coming to about the size of the Scottish Oil Fund. Okay,
thank you. Let's move on. Jamie, to be followed by Gavin.
Thank you, Convener. I want to return to the issue of the starting position for an independent Scotland in relation to debt. And given that we know that debt's not been issued in the Scottish Government's name, the UK Treasury has confirmed that it will take on responsibility. Dr Armstrong referred to that. Given the Convener referred to the precedent for debt remaining with the capital of the state which took on that debt, and the point made by Jim and Margaret Cuthbert that the debt position might be overstated. Return to, I think it was Dr Armstrong's point that walking away from debt is unreasonable. You would all surely then accept that the Scottish Government's proposition is reasonable. They're being reasonable in their approach to this matter.
You mean the fact that the Scottish Government have said that, as far as I follow, that they think that it's right to take on a fair and equitable share?
Indeed.
Absolutely.
You'd all
well, hang on, can I just clarify? You know, these terms fair and equitable are kind of nice and big and open, but I believe that the proposition of a population share of debt is quite widely discussed. I think that would constitute a fair and equitable starting point of a negotiation, and I think you could make arguments both ways from there.
But the basis that the Scottish Government has said it will take on a share of debt is reasonable.
Yes.
They are being reasonable.
Yes.
And you would all accept that.
No. I think, to be clear, I think that if the government's position was not to take on a share of debt, I think that'd be very unreasonable.
I understand the customers might think they're being too reasonable, but I suppose the point is they're not being unreasonable in terms of entering negotiations.
Well, I think one doesn't enter into negotiation by offering up one's hostages to fortune. One enters into negotiation with one's maximal position. And as I said, as an outsider, one can only interpret the position on debt taken in the white paper as being under the assumption that they're going to be met with a reasonable converse negotiating position from the other side of the table. Now, quite clear they are not going to be met with such a reasonable converse position. So my view would be that the position taken in white paper now falls.
So your position is that the Scottish Government's being reasonable, the UK Government's being unreasonable?
The Scottish Government started negotiations being entirely reasonable and were met with an unreasonable response. To my mind, I don't know, I don't speak for the Scottish Government, I don't know what the thinking is, but at that point the Scottish Government would have been perfectly justified in saying, well, the reasonable position we adopted in the white paper is now withdrawn.
Okay. So we do accept they're being reasonable. That's a useful position to get to. Thank you. In terms of your paper, Jim, Margaret, you touched on this a little earlier. You started to talk about quantitative easing, and I know you've set it out in your paper. I just wondered if you could talk about that a little bit more in relation to the calculation of the UK's headline debt figure. Just put a bit more on the record in terms of what you were talking about when you were talking about the quantitative easing issue.
Yes. The amount of UK gilts which have been quantitatively eased at present to 375 billion, which amounts to just more than 30% of the current UK headline debt. Not merely that, but the interest on that circulates back to the Treasury. So, in fact, the actual interest payment in GERS, Scotland is given something like 4 billion as being its population share of current UK debt interest payments. In fact, 30% of that should be subtracted off, almost $1 billion of that should be subtracted off, because it's not a payment which is actually made by the UK government at present, given that it circulates back immediately to the Treasury. The logic of that, in terms of the national accounts, is that the quantitative easing is a temporary measure, and they're trying to give a view which is abstracted from that temporary measure. But the point we're making is that it is now looking increasingly unlikely that quantitative easing will be reversed. And we give a quotation from Ambrose Evans Pritchard, but even someone like the Governor of the Bank of England now refers to any relaxation of quantitative easing rather than the fact that it will take place. And we saw the difficulty that occurred in the markets when the Fed said that it might reverse quantitative easing. It is looking extremely unlikely that this is going to be reversed. Now, I don't know whether it will be reversed or not, but we certainly cannot take it just as being a fact. This is a purely temporary intervention, and that the headline debt should stand at what it is.
I could also say, Jamie, that this has dynamic effects on the rest of the economy, because it's actually fed an asset bubble that we're all experiencing just now, especially down in the south, of house prices rising and all other asset values such as the stock market rising incredibly. So we've got a big bond bubble, and that too is affecting our future on the way through. So this quantitative easing, although we've worked out its effects on the size of debt, is also having an effect on the entire workings of the economy. So that what looks like an improvement in the UK economy is very fragile. And as we've seen, per head, it's really not an improvement at all.
I mean, it's interesting to quote from what Andy Haldane, who's the Director of Financial Stability, or words to that effect in the Bank of England, said to the Treasury Select Committee on the 12th of June. He said, let's be clear, we have intentionally blown the biggest bond bubble in history. That is where we are, so we need to be vigilant to the consequences of that bubble deflating more quickly than we might otherwise have wanted. And he singles out the consequence of quantitative easing as being the biggest risk to global financial stability right now.
Thanks, that's helpful. Also in your paper, and this is turned to the scenario that obviously I hope doesn't happen, but let's say there is a no vote. You talk in your paper that it is in fact difficult to see how Barnett can survive in its present form, and I believe that Joe Armstrong's also said something to the Economy, Energy and Tourism Committee.
Before you go on there, I should really let Dr Armstrong come in with us to comment on quantitative easing, and then if Professor Armstrong wants to come in as well.
Okay. I didn't know they wanted to, sorry.
Sorry,
I was
sorry.
quite away into my question.
No,
there,
I do
Convener.
apologise for that, Jamie. That was myself. That was my fault.
Yes, I think this idea of well, first of all, I feel like I'm beginning to sound a bit like the bogeyman here, to say no to everything. The idea that the QE assets can be just somehow crossed off, I think, is erroneous. I think it's just false, frankly. What might be the either intended or unintended consequences of the whole QE programme that Margaret and Jim have been pointing out, I have a degree of sympathy with some of what they say about that, but I don't think that's quite the issue with respect on this matter. The question is whether that should be taken off the debt. And one of the interesting, so first of all, the assets are held in the Asset Purchase Fund, which is a wholly owned subsidiary of the Bank of England. Now, if they somehow were to be crossed out, that would mean that the Bank of England would have a hole in its balance sheet. So you can't just cross them out. So then you say, well, maybe you won't cross them out and maybe you won't buy them back, but as they mature, they'll just disappear. But as they mature, you have to repay somebody, otherwise you've got that hole in your balance sheet again. Right? So at the last day of the bond, you go and knock on the government's door and say, here you go, it's maturing. I would like to have my £1,000 per face value, my £375 billion back now, please, as you have promised on this gilt, or you're defaulting. Now, assume you're going to be paying it, which is the UK government said they will honour all its debt. So therefore, they have to pay this stuff. And as the convener pointed out before, you don't just have that sort of money in your pocket, you have to issue new bonds. Once again, you're issuing new bonds of exactly the same value, this 375. So it doesn't just go away, unless you put a hole in the Bank of England balance sheet. The only way you can do this is if the UK government was to issue gilts to the Bank of England, for which the compensation would be that you would have a liability to the government on the Bank of England's balance sheet that the government then says, you know what, we're walking away from this. We're writing it off. That would be direct monetization. That's not what's happening here. The relationship is not with the government, it's with the private sector. The opposite asset, sorry, for the assets which have been sold and which have been bought by the government, the assets that have been sold by the private sector. And in selling those assets, they've accumulated something called reserves, reserves held at the Bank of England. Those reserves are money that you owe the private sector. To just somehow cancel this or not repay it would actually take £375 billion out of the private sector. That would be a default. So it's just not correct to say you can just wipe this out or it'll mature and it'll go away or whatever else. So, yeah, no
Professor Armstrong, do you want to say anything first of all?
Simply to say that I think you're right, the financial markets are still sick. We still don't know how to understand how the financial markets are going to operate effectively in the future without maintaining at least this level of QE. And they were brought in to maintain liquidity for the banking sector and to stop deflationary effects. So whilst we might be thinking we're seeing inflationary effects at the moment, they were there for that reason. And I think the issue about an asset bubble, I think there's certainly enough debate around to say that it's at least questionable that some of the house price effect is actually real because of lack of supply, not because of QE.
Okay, Jim, final point on this before I'll go back to Jamie.
Two comments, I think. One is that, I mean, we've wandered into, to my mind, Alice in Wonderland territory here. Yes, there's a hole in the balance sheet of the Bank of England, and somehow that's a problem for, for the Scottish independence. It's ludicrous. The financial weakness of the UK is being used as an argument why Scotland can't be independent. It's the other way around. If the UK, if there's a huge hole in the balance sheet of the Bank of England, more reason why we want to be away from it. But secondly, the war loan solution. I mean, redenominate the maturity of these assets to be infinite, effectively do a war loan on them, and that solves the problem. So, you paper over the hole in the balance sheet of the Bank of England forever.
Right.
So just to be very clear, there is not a hole in the balance sheet of the Bank of England. The proposition there would be a hole is based on the idea that somehow you say all of those gilts outstanding, all of the quantitative easing transactions and the asset that the Bank of England has to the asset purchase facility, that would somehow be put to zero. That's on the basis of that hypothetical idea. It doesn't have a hole in its balance sheet, so just to be absolutely clear on that.
No, it can be papered over. But I mean, it's not us who are saying that this will never be reversed. The serious commentators are saying it will not be reversed, or the probability is it will not be reversed. And I gave a quote from Ambrose Evans-Pritchard, and Ambrose Evans-Pritchard is a serious right-wing Telegraph economist, and he's saying it will never be reversed. You've got to take that seriously.
Okay, right. Well, we've got all there, actually. Sorry, Jamie, back to Barnett.
I wouldn't go through the preamble again, but the point it's making is the Cuthberts referred to Barnett in their paper, saying that they foresee difficulty in seeing it surviving its present form. And I think the point was going to make is Joe Armstrong had also said something broadly similar. I think you'd suggested that there could be challenges to the Barnett formula in future. So the question is, what do we think is likely here? What changes do we anticipate being made to Barnett in the event of a no vote, and what could the implications be for Scotland's finances?
Yes, I have been on the record saying I think the Barnett formula is up for negotiation. It is a statute of political negotiation, so it's interesting itself to see how when politicians negotiate around finances, what you end up getting. I think it's up for negotiation for a variety of reasons. First of all, it isn't something that is as transparent as the Barnett formula might suggest. It is something that is principally a black box in many cases that as you start to unpick it, and as the Cuthberts have significantly improved our understanding of it, that as the more you look, the more you find. I think the Welsh Assembly Government not that long ago identified that actually there was an asymmetry in the treatment, for example, on non-domestic rates, which then forced the change in the Barnett formula for the Welsh Assembly Government. You're also seeing the likelihood of the Welsh Assembly Government arguing that because on a needs basis, Wales should get more. If you've got a fixed budget, and we're looking at budget cuts rather than just even fixed, that suggests a change to the Barnett arrangements that are currently in place. You could also argue that as Scotland's North Sea tax revenues begin to decline, it becomes harder to justify its higher per capita share of the block grant. But also with the tax powers that are coming through in the Scotland Act tax powers, that in itself is creating a change to the Barnett formula. So the Barnett formula is a creature of, as I say, politicians, and is always up for negotiation at the margins. I suspect we're not talking about necessarily marginal change, but I would not expect to see significant change overnight, and it will evolve as the negotiators, the politicians, negotiate what's acceptable, both to their local politicians but also to their national governments.
It's a process for negotiation, is it? Because the UK government could just decide, couldn't it?
It hasn't been something that's just been decided. It has been something that has been developed as a consequence of negotiations.
And what do you think the likelihood would be for Scotland's public finances? I know it's very hard to answer that question. But I
think it's also important to note that the Barnett formula isn't just a per capita share of the equivalent spending departments, because actually it does get circumvented. So there are times when Scotland gets funding, as do other parts of the UK gets funding that's not just Barnett consequentials. So again, it's important to note that the allocation of funding from the UK to Scotland isn't just based on this relatively arcane Barnett formula arrangement. And it does depend on having strong negotiations, and I certainly know since it was established, it's principally been beneficial to Scotland because of strong negotiations from Scotland, and I would assume that that would continue.
As Joe says, although the Barnett formula looks as if it's the main part that affects the DEL, and there are ways that have been round about it, although these were tightened up considerably in the 90s. When we first were doing quite a bit of writing on this, we actually referred to it as the Barnett squeeze, because at that particular time, the underlying conditions affecting the Barnett were indeed squeezing Scotland's relative finances. But things have changed with the recession and with the growth of population in the rest of the UK. So it's not fixed in time, and right now we're actually benefiting from the Barnett.
I think the
question more though, you're saying we're benefiting by the Barnett formulas, but the question is, what happens if that changes? And you're suggesting from your paper it's difficult to see how Barnett can survive in its present form. What do you see as the likelihood being?
That we would then get less.
And can you quantify that, or is it possible to do that?
Well, the trouble is that the Calman changes themselves will affect it, and the new suggestions by Labour will themselves affect it even more. So we haven't done a simulation model.
And I think the interaction with Calman is important here. And a point we make in the paper is that there have been changes suggested to Calman, and if you increase the Calman threshold, in other words, if you say, rather than having control over 10p, it goes up to, say, 15p, you make one of the problems associated with Calman much worse, which is the instability associated with the with fiscal drag, or with any change in the proportion of tax coming from the different bands. So any change to Calman would have to be handled with very great care. But going back to Barnett, it was really only when we started to do the figures associated with producing this note that we realised how serious the position was. I mean, the interesting thing is that when you bring in relative population growth into consideration of Barnett, the normal view of Barnett will be that if nominal expenditure in England is rising, you'll get convergence towards equality of per capita spending in England and Scotland. Once you bring in relative population growth, that simple picture clouds. And you do get convergence to a limit when expenditure growth is greater than relative population growth, but that limit is not necessarily equality. And the example we give in our paper really surprised us, which is that, according to our model of Barnett, if you had relative population growth round about what it is just now, which is about 1.003, and 1% nominal growth in expenditure, then in the long run, per capita spend in Scotland, that is DEL per head on devolved services, would tend towards a limit which is 40% higher than that in England. Now, that convergence will be relatively slow, but nevertheless, after expenditure growth has resumed, as long as expenditure growth is low, you're heading in the wrong direction, which is why we said that we regarded Barnett as being, in effect, doomed in the current circumstances. Now, what would replace Barnett is unclear and would depend upon a political negotiation, clearly. But in the present circumstances, it would not be good news for Scotland.
Okay, thank you. One last question, if I may. Convener, that picks up on the point Angus Armstrong was talking about countries handling the volatility of oil and gas. Obviously, Norway established its fund in 1990 and made its first payment into its oil fund in 1996. It's now worth some £500 billion. I suppose the question is, should the UK government have established an oil fund, and why haven't they? That's a question for everyone.
So the question is, should they have done this? So we're doing a sort of history bit here.
Indeed.
I think the answer...
I just asked about the future, and it was somewhat unclear, so let's ask
I think the answer to that question is, looking back in history, there is merit to suggest that would have been a good idea. There would have clearly been other tougher choices that would have had to be made because that money was used for something. But on my reading of history, I think that would have been a good idea.
I think I can answer the historical question with a quotation from the Cabinet Minutes of 15th December 1977, which was, in the quotation, I quote exactly, "Above all, the creation of an oil fund would play into the hands of the Scottish nationalists for whom it would become a major political target." And I think that's explicitly why we didn't get an oil fund.
And learning the lessons from history, should we seize the opportunity to do so in the future?
If we set up an oil fund just now, we have to explain where we're cutting spending, because at the moment we're running a fiscal deficit. So yes, we should have an oil fund, and certainly if we're independent, we should seek to have a reserve to help support whatever currency arrangements we put in place to deal with shocks. But to do that, we need to explain where the spending is coming from, because we're currently having a fiscal deficit.
But not to do so in the future would be a missed opportunity.
I think it's needed if you are an independent, and a high proportion, a significant proportion of your tax rate revenues and your economy then is related to that hydrocarbon activity.
Hold on a wee second. What's a supplementary from Ian?
Sure.
And then we'll let you panel back in.
Very quick supplementary on that. The White Paper is clear on where the resources for the Stabilisation Fund that Joe has just described will come from. It says that the money will be borrowed on the money markets, and I just wonder if the panel think that's a good idea.
He suggests you have to weigh up the pros and cons of that. If you're borrowing at one rate and generating a return at another rate, so long as the borrowing rate's lower than the investment rate, that's a good thing to do. But if it's not, then it questions why you're doing it. And as I say, in order to borrow for that, you're not borrowing for something else, and we have a fiscal deficit, which means we need to borrow money. So there are trade-offs here that we need to have an understanding around what we're using the funding for.
Yes, I mean, I think the discussion is in danger of becoming a little bit static. I mean, the whole point of independence would be to change things. And the ability to establish an oil fund would depend upon what could be done in the medium to long term with the Scottish economy. And that's not about talking about current levels of taxation on oil. It's not necessarily about altering levels of taxation on oil. It's about altering other things. So what you would want to do would be to use things like licensing conditions to make sure that more of the benefits and multiplier effects of oil-related expenditure stayed in Scotland. I mean, the point we make is that at present, Scotland does 85% of the oil extraction and 45% of the jobs in the UK. One would want to alter that position by things like licensing conditions and deals and taxation, etc., so that the economy altered, so that the associated tax revenues in the general economy altered as well. And the ability to establish an oil fund would be critically dependent on the ability to make that sort of change.
I answered the history question, but I think then you made it into a future question. And the future question depends on what return you expect to get for the assets that you put in the oil fund versus the amount you're paying on your borrowing. You know, there's not much point in taking a big mortgage, i.e. having a lot of debt, if you just leave the money in a bank earning a very low interest rate. You're actually much better off paying off the debt. And so I think it's a question of looking at the relative returns before making a conclusion.
I'm sorry, I have to go back to the question as originally asked by Jamie on, about the oil and setting up the fund. As far as the latest figures for HMRC go, there's over 400 billion being paid in tax cumulatively from all the different forms of oil. And it's quite clear that the UK government has used the taxation of oil, and sometimes in a very short-term means for political reasons at that time. For example, George Osborne has himself changed the tax situation. And that has meant, for example, in the latest one, that oil fields old oil fields were just stopped, and we lost quite a bit of that at the time. What you're wanting to do with an oil fund is not only to protect the resource so that you can use it for the future generations, but you also want to make sure that you're actually using it to extend research and development in Scotland and produce the types of engineers, etc., that will be at the forefront of coping with oil, and that's worldwide, and we haven't been doing that.
Said it'll do is it'll establish this when the conditions are right. And if we actually look at the Norwegian precedent, the fund was set up in 1990, but they didn't make the first payment until 1996. So essentially they did the same thing. It seems a reasonable approach, doesn't it?
I don't think you can compare the conditions in Norway with the conditions that we're talking about for Scotland. Norway had to do it because it was having a serious detrimental effect on its non-oil activities. So it decided it would not spend its oil money by putting it into a fund and therefore have less of an effect on exchange rates and interest rates. The UK government, or Scottish government, I beg your pardon, the Scottish government's quite rightly said it will build an oil fund as and when it sees conditions are suitable. The challenge with what Margaret and Jim are suggesting, and I fully endorse the idea of trying to maximise the value of North Sea revenues and North Sea activity staying within Scotland, but you've got to think about EU procurement rules and whether you could actually do that on licences. Clearly it's something for negotiation, but you've also got the fact that the North Sea is an ageing asset. It is an environment where if you don't exploit it now, the pipelines, the platforms, the activity, the boats, the servicing arrangements are ageing and therefore will at some point have to be replaced. If the tax regime is not accommodating, then that will get replaced sooner or get closed down. So there is an idea of let's do something medium to longer term, but actually the challenge at the moment is to exploit what's possible from the North Sea now because it's ageing and costing more to exploit.
And then we're going to move on to a question from Gavin.
If I can say that what actually puzzles me a great deal, both on the white paper and what Joe was saying just now, is that in this negotiating phase, should we get a yes in the referendum, there seems to be we will be going into into the EU, we will be doing this, that and t'other. Surely at the negotiating stage we should be throwing the net wide, and one possibility is that we don't go into the EU and in fact consider EFTA, in which case we actually are not bound by procurement rules on oil. But it's a general point that the government seems to be taking in its white paper a very definite stance of the things that we're going to do, rather than actually looking at potential different ideas.
Gavin, to be followed by Jean.
First question is purely for clarity. Was Margaret Cuthbert raised a figure of £400 billion? Can you just for clarity where what that figure comes from, exactly what it represents?
This is one of the latest HMRC papers on oil and gas.
And that figure is what the cumulative.
This is both cumulative and covering all the different types of tax. So, for example, it covers the petroleum tax, anything that they have got from offshore oil in the UK, not just from Scotland. Well, I think the first oil came out in 1975.
Cumulative. Okay.
Yes.
All right, thank you.
In
Right.
today's prices.
Okay. I'm grateful. The next thing I wanted to ask about is the paper that Jim and Margaret Cuthbert submitted, issue 5. You're talking about income tax and the different, I suppose, income tax profile, the slightly differing profiles between Scotland and the rest of the UK. You conclude, though, that this points to the need potentially for Scotland considering new forms of taxation were we to be independent. Can you just expand on that? What sort of forms of new taxation did you have in mind?
Well, if I can start with on the income tax base itself, you'll all be very familiar, of course, with the huge long tail in income tax, and in income first and in income tax for the UK. So there's more than 11%, I think we've written it, of the figure varies, sometimes it's higher than that is actually raised by a very small number of people. We don't have that tail in Scotland. So if we were actually going to be independent and we're using the same system of taxation as is used in the UK, then we wouldn't have this extra coming in, which would make it seem as if Scotland would be in a poor way. We're looking at it instead of being Scotland is not as vulnerable, because every time in the UK, when they try to change taxes, like raise it to 50% or put in the bonus, the tax and bonuses, as you will already know, taxation, in fact, of this, they are so able to change their pattern of taxation that you don't raise the tax you think you're going to get. And we're extremely vulnerable to what's happening in the financial sector. So the rest of the UK isn't in a happy position right now with being so dependent on income tax. Scotland doesn't have that problem, but on the other hand, we don't have this vast amount coming in, which we think is actually as volatile, if anything, as oil. In fact, more so, because we think the UK will not necessarily keep going with this huge financial sector. But what we think is that there are a number of other areas in Scottish life that are not taxed at present, to the detriment of Scottish life. One of these, for example, is land. You also all know that, for example, there are people from any other part of the world can come in and buy up land in Scotland, Ireland and the rest of the UK, and there are very few, if any, restrictions, and that we are probably unique in the rest of the world for that happening. and it's got its consequences in that land prices are higher in Ireland and the UK than elsewhere in the world. So we have to think about that, and one possibility that politicians might think of is a land value tax. We've also seen, for example, that there's a huge increase, especially up in Aberdeenshire, of lifestyle properties, which are actually taking away from agricultural production and agricultural land. Politicians, again, have to think, is that what we're wanting? Should we actually be taxing land so that we increase its efficiency and at the same time it reflects the type of Scotland that we want, while at the same time plugging a hole in helping the type of tax environment, spending environment that we want. And another huge one is our assets. I mean, Joe pointed out very clearly what we all know, which is that our assets, in fact, are owned by other people to a large extent. So that, in fact, in whisky, the Johnnie Walker label is owned by a small company over in Holland. Now, we have to somehow or other manage to start getting these assets, which are Scotland's assets, to produce a return in Scotland. And that holds whether it's coffee shops or whisky or land, as far as we're concerned. And there are means of doing it within the EU.
In terms of the, I mean, you laid the advantages and disadvantages of the income tax scenario, but the disadvantages you pointed out is you've not got this swathe of money coming in. Have you looked at how large that amount of money not coming in would be, and therefore how much would we need to collect additionally from, say, a land value tax or other measures?
No, but it wouldn't be hard to do. I'm quite prepared to do it in a note if you would like that.
Okay, no, I think that would be helpful. Thank you. Okay, moving on to something. Just there was a comment Jim Cuthbert made just when we were talking about not including QE in terms of the overall debt level, and I think you used the expression it could be papered over. That's something I've written down. I mean, are there other economists or experts out there who are saying similar things, that it could be, to use your expression, papered over? Because it was certainly new to me, but I mean, are there other experts out there saying an issue of this magnitude could be papered over?
Well, certainly there's been quite a bit of comment in the press as to whether quantitative easing will ever be unwound and how this could be done. Other than that, I don't know.
Okay, so there's others questioning to what extent it will be wound down, but I mean, I think you suggested something different in terms of your expression of papered over. Are there others saying that, or is that sort of your view, as it were?
Well, if it was not wound down, then something would need to be done. The obvious thing would be to extend the maturity of the relevant assets. But I'm not aware of, say, academic work on how that might be done.
Okay, let's move on to another issue. This is a suggestion of when debt is divided, the starting point or the basis on which you do it. And suggestion, or just one suggestion, and it was the 1980 position, which I think Jim and Margaret Cuthbert's paper has suggested. But in Joe Armstrong's paper, or the CPPR paper, the point is made that there aren't any examples, or at least you weren't able to point to any examples of what you call historical disentanglement. You mentioned some. I mean, are there any examples of historical disentanglement of countries where they've, rather than looking at the position at the time of independence or change, they've gone back to 1980, for example, or a different year and disentangled it that way? Does that have a precedent? And that's open to any panel member who wants to comment.
I think in the Quebec situation, there was 4 different ideas being proposed. You had the affordability, population, and then you had one by a sort of slightly archaic formula. And I think the other one had a degree of backward looking. But apart from the affordability and the population, the other 2 measures were sort of positions from people who took positions if you know what I mean. People who had historic, and the other one was a formula, which, not surprisingly, one got a lower number, the other one got a higher number. So that's the only, but of course it didn't go through, so we don't know where it would have come out. So it's kind of academic, really. That's the only place that I think people have looked backwards that I know of.
I'm not aware, but I mean, each case is individual in its own rights, and is necessarily so. And we shouldn't be expecting to find a precedent that one could just wheel out and apply in any individual case.
I was just asking if there was one, but I mean, sure. Okay. If we move to the next area, then the issue of fiscal tightening. I mean, this features in Dr. Armstrong's paper. You suggest there would need to be fiscal tightening were Scotland to be independent, and your view on the projections is that it would be a greater fiscal tightening than the rest of the UK if we were to reduce debt and deficit and so on. Now, the white paper itself, as you will know, has a single year's figures. It only has figures in there for the financial year 2016-17, but that suggests that actually the net fiscal balance in Scotland would actually be in a healthier position than the rest of the UK in that particular year. On the most up-to-date projections that any of the panel have seen, can that position be supported? Are there projections that suggest that Scotland would be in a healthier position in terms of its net fiscal balance in the year 16-17?
Certainly the work that we've been doing, and we will have been relying on official data, so we're not looking to adjust arbitrarily. Although we have done a piece of work that says if you did take out defence spending and made it equivalent to, I think, Ireland's level of spending, if you did achieve the upper range of the now accepted historic set of figures from the Scottish Government on North Sea tax revenues, and if you used a lower share for international aid financing, then you could see a surplus by the end of the projection period. It's 18-19, I can't remember if it's 16-17 or not, but you could see the possibility of a surplus coming in, but it did require quite substantial adjustments of those types. And I know Margaret and Jim have both suggested the defence side and international spending is something that's open for debate. The issue would be, at the moment, the white paper suggests spending is equivalent amount primarily on defence than is currently assumed within that kind of those GS figures. So it's not clear how you see a significant sustainable surplus being possible by then.
I wonder if other panel members have views on that. Okay, but on the issue then of fiscal tightening, I wonder if Dr. Armstrong can just say, maybe just for the record, his view on the best projections, and I accept these are projections, what sort of level of fiscal tightening on his most up-to-date projections is would be required?
So the exercise that we did in the evidence that we presented was very specific. Just to reiterate, we assumed that in 10 years' time, having gained independence, an independent Scotland would target a 6% debt-to-GDP ratio. So it's on that hypothesis. If you don't agree with that, you get a whole different scenario. And it's perfectly reasonable to think it should be lower or higher. But on that one, that's where we got the estimates of the fiscal tightening, the 8% of GDP fiscal tightening, or slightly higher, and it being tighter than the presumed tightening in the current UK governments. But that is just a scenario. What it would be by 16-17, that exercise we haven't done. We've tended not to look at 1 or 2 years out. We've tended to look more further out because we've always been asking the question about the sustainability of the currency regime as being paramount in our approach to this.
If I could point you to page 26 of the papers you've been given, there's a table 4, which is our projections out to 2018-19. Based on the most up-to-date GERS figures. And that gives you an indication of the fiscal tightening that would be required. So if you take the top line, it shows you by 2018-19 or 2016-17, if that's the year you wish to choose, Scotland's fiscal deficit is about £9.4 billion in cash terms, compared to, and that's equating to about 5.5% of GDP, compared to UK 2.4% of GDP. And by the end of the forecast period, when the current fiscal austerity measures are deemed to deliver the fiscal targets set by the UK Chancellor, the UK is in fiscal surplus, and Scotland would still have a fiscal deficit of around 3% of GDP. Equivalent to about £5 to £5.5 billion of additional cuts to get us back to fiscal surplus.
I guess same question to Jim and Margaret Cuthbert. I mean, do you think there would be fiscal tightening required over and above the UK level? Do you think there would be no fiscal tightening required, or somewhere in between there? Do you have a view at this stage on the level of fiscal tightening?
If I could speak first. First of all these figures are really based on the OBR, oil and gas. And while Joe has commented that the Scottish Government ones figures are historic and need to be updated, there's a huge gap between the two, and I think the OBR figures, many people in my position would regard them as being far too conservative, and the DEC has already said that its figures are very conservative, and the UK oil and gas people have much higher figures for oil and gas, so I'm very cheery about that. I also think however, that we are moving into, if we do get independence, we have to accept that we're moving into a transition phase. And in a transition phase, there is uncertainty. Therefore, there are likely to be costs. But these costs of the short term are much more likely to be well worth enduring because of the returns that one we are likely to get in the longer term. One big return, for example, that I think we must remember is that at the minute, only 38 young men out of every 100 going to university in Scotland who are Scots actually manage to get a graduate job in Scotland. We export an awful lot of them. That the levels of those who are neither in employment, education or training in Scotland are extremely high, particularly in poor areas that are suffering multiple deprivation. So there's a lot to be gained in the long term. I think we're looking at too short a period. We may well have to have fiscal tightening in the short term, but the prize is rather large in the longer term. But one of the things that could help us on our way, that we've put in quite a lot in our papers, is that energy pricing, utility pricing in the UK is following a wrong model. Eventually, the Audit Office in England has finally paid attention to this. This is work that's been done by Jim. And we're paying far too much for our utilities. If that price was fixed, it would fundamentally affect the whole of the Scottish economy and our ability, therefore, to generate taxes. And secondly, we would also be hoping that it would be a proactive government that was in place so that those projections Angus gave for 10 years would be radically different, because we would be involved much more in making sure that we got a big amount of research and development from those natural assets that we have, and also that we would be able to make sure that we did get the tax that we ought to be getting in our own country.
Could I just comment, make two comments really. One is that even if you don't assume that Scotland is debt-free, but bringing in the quantitative easing point and bringing in the defence point, etc., then probably the fiscal deficit is overstated by something like 2.3, 2.5% of GDP at present. So that would have to be offset against any potential tightening. But the other comment I'd like to make is that we're making comparisons with the UK, and the work that's been done, as far as I can see in the UK, takes the OBR figures, the OBR forecast of GDP growth, and we are, in taking those as a given, we are neglecting a point which we discussed previously in this committee, which is the nature of the risk assessment in the OBR forecast. And as I have argued in the past, since the OBR accepted a forecasting remit, it effectively understates the risks attaching to the UK economy for two reasons. One is that if you're forecasting in a policy-related environment, you'll almost always assume the success of policy. So the OBR simply assumes that by the end of its forecast period, the UK economy will be back on a trend path of growth. That is simply an assumption. We don't have much evidence for that. Secondly, if you're forecasting, you tend to neglect the possibility of black swan events. And I've indicated why, in my view, in terms of the international balance sheet of the UK, a major correction is almost inevitable within, say, the next 9-10 years. The possibility of that occurring within the OBR forecast is just neglected, quite rightly, because if you're forecasting, you cannot forecast black swans. So for these two reasons, the risks and uncertainties attaching to the UK position is just completely understated if you just take the OBR forecast as a given when you're setting out your OBR benchmark.
Can I just make a couple of... on the projections that we did, we had to assume a growth rate. And we assumed 2% growth. And you may say, well, it's going to be higher, it's going to be lower. And certainly some of the issues have been raised about reform of real estate taxation and financial sector taxation. I completely agree with. I think there's a lot that could be done with those sort of taxes. But 2% GDP growth, that is, most people assume that there is a decline in the revenues you're going to get from the North Sea, that there is a finite resource there. So the overall GDP growth, it means the non-oil part is probably going to have to grow faster. And we've got 2% despite a pretty aggressive fiscal tightening. You could argue that might weaken growth, but we've assumed it doesn't. So it's on the basis of a 2% growth forecast. Is that pessimistic or optimistic? Well, you have to make your own choice. You have to assume something. On the issues that Jim pointed out about the OBR, well, almost by definition, you have to assume something goes back to trend, otherwise it's not the trend. Black swan events, I have a degree of sympathy. There is an interesting question about how do you communicate risks effectively? That is a very fair question. And certainly in our approach to discussing different currency arrangements, there's one point we're trying to make, is you have to look at the risks. Don't just think about the good day. Think what happens in the bad day, and then see what the situation might be, and then back it out and think, well, what's the best currency arrangement? So in terms of thinking about these sort of black swan events and risk management approach to this, I completely agree with them. That is the right way to do it. It's just a bit of a challenge of how do you present that, but I think that the point is correct.
Just on the narrow point of the OBR oil projections, I mean, would it be fair to say that for 12-13 and 13-14, the OBR projections have actually been more accurate than the other four Scottish Government projections?
They have been, and also the OBR would quite rightly say their forecasting track record's not good. They have consistently, as have DEC, consistently overestimated when they start the process. And DEC, as have Oil and Gas UK, have consistently been optimistic on production. And the issue about prices, as somebody who worked in the industry a long time ago, when the oil price was $100 and it collapsed to 10, I stopped forecasting oil prices. They're notoriously difficult to forecast. So the OBR's projections are, yes, they could well be perceived as being pessimistic, but they are realistic, and they have in the past been extremely optimistic.
If I could comment on that, about the OBR projections, it is important to realise too that the oil figures that we've been having of late have been very affected by maintenance and investment that's been going on. So looking at those profits figures and therefore the taxes that came in were very much affected by those, and that's not to say that is any basis for how one would proceed in the future.
And the projections take account of the upturn as a consequence of the steadying of the production levels that came as a consequence of the investment that's currently taking place. So they do take account of the impact and the benefits of the investment that's currently been taking place in the North Sea.
One last one, if I may convener, just a statement from Jo Armstrong's paper. I just wouldn't mind if she would expand on. It's your paper, I mean, it's page 11 in the papers we have, but it's from your paper about Scotland assuming a low or zero share of the UK's existing debt. At the bottom of that first page, you say there's an argument for assuming a zero share as a quid pro quo for Scotland not being allowed to share a formal monetary and currency union with the rest of the UK. Over the page, you say, this is the Scottish Government's current rationale for assuming zero UK debt. However, the argument is flawed. I just wonder if you can, I mean, obviously you have paragraphs go on there later, but can you just, in terms of that, the argument that you're saying it's flawed to say that not assuming a debt share is not a quid pro quo for not entering into a formal currency union. Can you just, for the record, explain why in your view that's flawed?
We have assumed the rationale for the Scottish Government arguing that if we don't have a formal monetary union, it's fair to walk away from our share of the debt, because it assumes that we're not getting the benefit of the assets of the Bank of England, and we're just saying that the Bank of England is not the asset, it's the credibility of and the track record of the Bank of England and the Treasury in support of the Bank of England, which is the asset, which doesn't have a monetary value attached to it.
Thank you.
Just on that point, can I just point out that the monetary value, so if you were to sort of look at it from a purely, you treated the Bank of England like any other asset, its net worth, so that's the assets minus the liabilities, its net worth is £3.35 billion. So a population share of that is about 280 million. Now, of course, that's a lot of money, but that's not the game changer. The game changer is actually having you do the business in future. That's what the issue is, right? It's not the 280 billion. What is it doing the business in future? Well, the Bank of England, the bits of paper that it issues used to be backed by gold. Now they're just backed by a promise, and that promise is to pay. And it's a promise on the people that the Parliament represents of that institution, i.e. UK taxpayers. I think most people would see it as an unreasonable proposition that an independent country, Scotland or any other, would automatically have a claim on the taxpayers of another country as a matter of course of business.
So just for clarification, when I said the Bank of England, I meant sterling was not an asset, it's the Bank of England, it's the asset. So, for clarity.
As far as the argument goes, I think that's absolutely fair. I can't see that you could have this as a bargaining chip in that way, that as it's been expressed in the white paper. But actually, it's still not right, because Scotland could, if it so chose, do considerable damage to sterling. It's not what's the value, as Angus was just saying, of the assets in the Bank of England or anything like that. It's what damage could be done if Scotland decided that, or if the UK government decided that it wasn't going to allow Scotland into its monetary union. Because at that particular point, Scotland actually has oil, which for a long time has boosted the finances of the entire UK. And I actually still disagree on the future of North Sea oil finances with Joe and the fact that the OBR, in its very conservative way, brought it into future projections. And DEC, as I said, has already said that they used very conservative, with a small c, projections in the way forward. We could do more damage to the UK's finances and to the standing of sterling than is allowed for in these comments being made.
Move on to Jean.
Yes, I mean, I think it is a bit of a red herring. I think it's implicit in what Angus was saying to talk about the Bank of England per se. I mean, what we're talking about is the tax-paying capacity and robustness of individual economies. And the UK without Scotland is not in a good position, highly dependent upon a grossly oversized financial sector, with international competitiveness that's been declining since the Second World War, and the emergence of a chronic deficit in trade and goods and services, which had been propped up in the 1980s by oil revenues and latterly, effectively, by borrowing. It is not a good, the underlying tax-paying capacity of the rest of the UK economy is not a good bet. And therefore, to talk about the strength and the robustness of the Bank of England, the pillars in the front door, etc., really is not it. It's the underlying economy you have to look at, and in terms of the rest of the UK, that is weak.
So, on the... Sorry.
Well, okay, briefly then, because
so I just have to
time's marching.
I completely understand. At this point, that the balance of payment surpluses would be, tremendously badly affected. The UK exports about £500 billion each year. It has about 60 billion to Scotland, and Scotland exports to the rest of the world, so the UK would lose Scotland's exports to the rest of the world if Scotland became independent, of about £20 billion. So it's £531 billion less the amount of oil that we would no longer be, the oil that we would have to import. That would clearly be a negative for the balance of payments, but would it actually be so detrimental? I mean, we do have a floating exchange rate for a purpose, and that's pretty key to a lot of this discussion. And so I don't doubt the fact at all that there will be a small balance of payments implications for this, depending on what the oil price is at the time. But the idea that it would somehow be a cataclysmic event for the balance of payments, I'm afraid I just don't see how that comes from the figures.
It's not so much the change. I mean, clearly losing Scottish trade surplus would affect the rest of the UK. But it's the fundamentals of the UK economy that one has to worry about. The UK economy itself is not currently in a sustainable position. As I said, its international assets and liabilities are over 700% of GDP. They're growing at a compound rate of 8% per annum relative to GDP. That means that in 9 years they will double. It's inconceivable, to my mind, that 9 years from now we have the UK going on with international assets and liabilities about 1,400% of GDP without something having happened in the interim. There just aren't that number of good assets for the UK. I mean, the UK is effectively operating like a very large bank, and it's expanding its balance sheet at about 8% per annum relative to GDP, and there aren't the assets the good assets for it to invest in to enable that process to continue for another 8 or 9 years. There's a strong likelihood of a UK crisis in that period, irrespective of whether Scotland goes or not. If Scotland goes, the likelihood is greatly increased.
Jean, to be followed by Ian.
Thank you. I guess I wanted to carry on that theme, really, that the idea, and ask you if you feel that there is any real change of direction needed in the way that we manage the economy of the United Kingdom. That I think there's, for some of us, a fear that there's more of the same to come, and that if we continue the way that we're going at the moment, then we will suffer the same consequences again in the not too distant future even. So, and the other thing I wanted to ask you was that I think, Angus, you, and I'm quoting here, that the oil would be better managed by a larger country. That's the volatility of the oil revenues you were referring to. And what if something goes wrong, question mark, or big, nasty shock? Would you say that that UK PLC had a big, nasty shock? And did it deal with it? Did it deal with it well? And further to that, if we are really thinking about the Scottish economy, rather than compare it with this large neighbour, who I think doesn't actually have a great international reputation for its economic practices. I think we're under a bit of an illusion about that. But those of us who think that Scotland might actually be better in lots of ways by being an independent country don't actually compare with the rest of the UK, but compare with countries of a similar size. And how they manage their economy. And what interest is there in looking at Scotland's economy actually in a different way, and not comparing just with more of the same from the United Kingdom, because clearly that's not what any of us want for Scotland.
Hey, Jean, let them answer the question, because the question is going to be longer than the answer. Angus.
I'll try and be very quick on that. But, change direction for the UK economy. I think that the UK is a remarkably centrist model. The lack of power not just to Scotland, but for the regions of England, but also Wales, Northern Ireland, and so on. So it's an incredibly centralist model. It's very hard to see that that makes any sense when you look at other successful countries. So that's the first point. Second, Jim's been pointing out the financial sector and the size of the assets and liabilities. I agree that we have this very large financial sector. It's, in terms of assets and liabilities, it's larger in Scotland, by the way, So, just be careful what you wish for on this one. But overall, does it look like we've really sorted out financial regulation? Of course not. We've got a lot further to go. I mean, it's extraordinary, actually, how little progress has been made 6 years after the crisis. I'm completely on your side on that one. I mean, 100% on your side on that one. Inequality, and a lot is made in this debate about issues of inequality. It's right across the whole of the United Kingdom. It's not just the rest of the UK issue. It's right across the whole of the UK. It's extremely corrosive for the economic progress. Immigration, the National Institute is probably, apart from a few smaller places, probably the most pro-immigration institute, academic institute in the UK, I guess. So I completely accept that point that we seem to be going backwards. This whole issue of pulling out of... I mean, it's exhausting that how the UK could do better. So I'm not for a moment trying to say that in any way everything's rosy, the other side of the border. Not at all. This is not really the question. The question is, what would the costs and benefits be for Scotland breaking the political links to the rest of the UK? That's kind of the question. On the question of risks, the UK did have a very nasty shock. How did it manage? Well, I think it managed actually reasonably well, certainly in the first 2 years, given the shock has happened, right? You can always argue you should have done things better before. That's obvious. But given the shock has happened, the first 2 years, I think, weren't too bad. What happened after that, I have differences of view. I think some of the austerity was unnecessary, for example, is the view, my own view and the view of the Institute and all of the modelling work that we've done. It's very important to look at what is the capacity for countries to do risk management in future, which is where having your own currency is pretty important. In the dark days of 2009, the beginning, sterling was falling, and we were asking the UK Treasury at the time was asking itself, what would happen if this continues to fall? How big a problem is that, given the other issues? In some ways, actually having that flexibility was a real benefit at that time. The issue about comparing an independent Scotland to other countries of similar size, I couldn't agree more. And so as countries, they don't burden themselves with tying themselves to another country's monetary system, which they would have very little control, most likely, over. So I couldn't agree with you more on that, and that's kind of what we've been arguing. There is an issue that some of these other countries don't start off with the same level of debt. That is exactly why we've been suggesting the debt for all swap, not to do a rate. That's actually, well, the point is, if Scotland, a small independent country with a much lower level of debt and its own monetary regime, it's pretty hard to argue against this. I really think that there you could start saying what sort of prosperous country could Scotland be and so on. A much more positive and progressive discussion than this, well, we want to have this and we won't do this and we will do this, where do we move? That's not getting us very far.
Jim?
Yes, I mean, I think I'd like to comment on this idea of whether large means good management. And it is not the case that large necessarily means good management. Another example from the UK, if you look at the UK's real exchange rate, in other words, international competitiveness since the Second World War, not merely has that been declining, it's also been subject to very marked medium-term variations, larger than most other comparable large economies. And that is explicable to a large extent by political folly and also to the destabilising influence of the city. But large does not mean that you're able to manage your currency in a stable way, and that has been extremely damaging to UK industry. And I think going back to 2008, I think one has to be cautious about reading too much into how well we handled 2008. What was happening in 2008 was indeed a world crisis in which we were heavily implicated, but our ability to respond and our ability to get out of it by effectively printing money was predicated by the fact that other people in the same crisis and were printing money at the same time. In another crisis, if it was more homegrown, if America, for example, was recovering and raising interest rates, then our ability to use the measures that we used in post-2008 would be extremely limited.
The big problems that were obvious in 2008 were obviously that we had an economy which was structured too heavily on the financial sector and not enough in manufacturing. And efforts were going to be made to improve manufacturing. In fact, very little of that has happened. And if anything, the banking sector is doing extremely well. And as far as the amount of money that salaries are now at. And we've also got inequality, which is even greater today than it was in 2008 across the different across the different parts of the United Kingdom. And what I would like to say is that it seems to me that it's extremely difficult for the United Kingdom to actually change. Its financial sector is dependent on there being, for example, a lot of mergers and acquisitions, so that Goldman Sachs, etc., makes their money on it. So no effort is actually going to be made against the numbers of mergers and acquisitions that are taking place. And so our competition policy and mergers and acquisitions policies, all of these related policies, are all geared towards the continuing development and success of the financial sector, which itself is affected by this massive bubble in asset prices that's going on. So I don't see any, for the UK, any big improvement. If we want that improvement, we have to have it on our own.
Yes, Scotland has a big financial services sector, so the issues relating to London are equally important for Scotland. But looking forward to I absolutely agree with you, the changes are needed, but the changes are needed across the UK, and the extent to which that's going to happen, I think that's for politicians to argue, but we definitely need a more effective regional policy so that it does stop the centralisation effect. But that brings with it challenges around EU, and if we stay within the EU, the ability to change lots of the regulatory regimes, lots of the mergers and acquisitions and competition policy, we have to accept that that's a given. So we need to look at how do we improve our skills base, how do we improve our connectivity, be that physical or through the airwaves. We need to look at how we be more competitive so that we can actually compete internationally. And we need to think through how probably public sector reform is absolutely essential. If we've got this financial constraint at the moment, and I think we're talking more about the magnitude of the fiscal deficit or the fiscal challenge as opposed to we've got a fiscal challenge in our hands to be able to maintain the current level of spending and growing levels of spending as a consequence of an ageing population or a desire to maintain certain types of public sector policies, then we've got to find means of actually increasing our tax base, and our tax base has to happen as a consequence of being increasingly productive, and our productivity levels are not good, so we need to find ways of increasing productivity. So to the extent that there's lots of issues to be dealt with, none of the debate around the referendum and very little about the debate around austerity is actually looking at new economic models, be that at the UK level or dare I say it within Scotland. But we need to be more productive. We need to actually improve competition and competitiveness. And I don't see that debate taking place at the moment anywhere.
Jean, before you come back in again, yes, but I think we've now been sitting here for 2 hours. 2 of the committee, uniquely, because it's not happened before, I've had to wander off to the bathroom. So I think, given the fact, given the fact that our witnesses have also been sitting there for a couple of hours, I wouldn't say there are no spring chickens among the witnesses, that would be inappropriate. But I do think, given the fact that Eugene has another question to ask, and indeed Ian and John are still to come in, I think a natural break might be appropriate for everyone, and also witnesses could maybe grab a cup of coffee if they so wish. So I'm going to call a wee halt for a few minutes. I won't say specifically because I want to make sure everyone gets an opportunity to go to the bathroom if they wish, and then we'll reconvene and finish off the session then. Okay, thanks. Okay, cheers. Okay, folks, now refreshed, one hopes, we'll restart the session. And Jean, a question from you.
Well, just really to follow on my line of questioning before, is that it's always difficult looking at a balance sheet when you're only looking at one side. And I know that a number of people have mentioned other, reduction in defence spending, possibility of land tax and so on, but that of course assumes full control of taxation in Scotland. But do you agree that that while we accept that we are where we are and whatever negotiating can be done, and I feel that personally that Scotland comes from a strong negotiating position in being able to negotiate that actually thereafter it is about the other side of the balance sheet as to the economic state that Scotland would find herself in. I mean, for example, on the land tax, I live in the Highlands and I have a landowning neighbour who is Danish and pays land tax on his land holdings in Scotland to the Danish government, which I think is quite interesting, whereas we actually don't collect anything. So it seems to me there's endless possibilities of Scotland managing the economy to suit Scotland's needs.
Who would you want to direct that to first, Jean? Anyone in particular?
Yeah. Well, perhaps just to, in view of the time, maybe Joe and Jim.
It's not probably infinite, it's probably being a bit over the top, but there are many, many ways that an independent Scotland could establish its tax regime and establish what revenues it's going to generate for the spending it wants to incur. I suppose the two things for me, one would be the world where we're talking about isn't the world we're currently talking about, and we've got to get to there. And currently we've got a fiscal deficit, and to fundamentally change the revenue position overnight is not easy. So how do we navigate from where we are now to where we want to get to? And I think the other one would be, and this is probably on the back of the work that the IFS have done in the past, I think it was the Murley's report, which says that for a small open economy like Scotland, which we could look to adjust and adapt our tax base to more reflect the needs and desires of Scotland, the likelihood is that the tax regime will generate less tax because you can and will probably want to have more mobile investment, more mobile capital, so you tend to have less of a tax base if you're a smaller country than if you're part of a larger one. That's just, you can you walk over the border if you don't like the tax rate that you're being charged. So fundamentally changing the tax regime is definitely a possibility, but again, be careful what you wish for, because it probably has consequences that might not necessarily give you all the answers that you want. But my fundamental one would be, to get to the world that you want to get to, how do you get there, and what's the implications for the fiscal outlook for individuals just now, the spending commitments that we're making and the spending commitments we want to make. It just gets harder the more visionary you want to be when you've actually got to navigate from what isn't necessarily a strong position at the moment.
Yes, I mean, I agree, Jean. I mean, it's how creative we are if we were independent. It would be essential to be innovative. But, I mean, this position is not hopeless, and we produced a paper last year for the Jamie Reid Foundation on Options for Scotland, on economic options for independent Scotland. And there's a number of things outlined there that could be done. What worries me more is the position we find ourselves in if we don't have those powers. I mean, I think I'm particularly worried by the position, if there's a no vote, if we are funding part of our public expenditure via Calman. We're relying on the income tax base. Calman is an ill-designed set of proposals. We will be forced, almost inevitably, to have a higher tax rate in Scotland. And we're looking at the prospect of long-run relative decline in the deflation in the Scottish economy. That is a prospect that really terrifies me. We wouldn't have the option to adopt the kind of innovative approach to tax, and something that Margaret was mentioning, but she probably wants to say more about. Margaret.
Well, if it's all right, I would like to say that there's actually tremendous flexibility in Scotland, or room for improvement if we were separate. For example, right now, employment rates among those who are living in poor areas in Scotland are shockingly low. The 15% worst in terms of most deprived areas have an employment rate of only 53%. And I mean, in Britain as a whole, we're well over 70%, and the rest of Scotland were well over 70%. So there's slack in the Scottish economy where people are deprived just now of any opportunity. And I mean, that's just one of the many figures on how poor we are in some areas. And so when we're looking at the future, it's not just taxes that we're going to be concerned about, but actually by bringing all these people into the economy, our tax base, anybody will become more secure and we'll be able to improve ourselves. So I would expect that that would be also an important thing. The tax base will improve. But I did say on the way through about the types of taxes that we could actually use. And I mentioned land tax and taxes, for example, on or licensing on whisky. But one of the things too that, as far as the public sector is concerned about, is PFI. Now, it's very likely that, I'm not a lawyer, but we might not be able to unpick some of the horrendous PFI contracts that we've got. But one of the things that is in every PFI contract is how much, this is the projection, how much it is expected that the company will be giving in corporation tax during the life of the project. It would be a not impossible exercise to then work out what they are actually paying and demand a rebate on the basis that it was a wrongful set of figures that they delivered in the first place, with actually, in most cases, no intention of ever paying the tax.
Thank you. Ian, to be followed by John.
Okay, thanks. And given the time, convener, I mean, I've got 3 questions which are really questions of clarification for some of the things that have been said previously, and 2 of them, I think, are really kind of specifically to Jim and Margaret. The first is, when we had the discussion around the Scottish economy's capacity to provide for an oil fund, I think there was general agreement that as things stand currently, setting history aside, as things stand currently, there are not spare free oil revenues which could be used to set up an oil fund. And I asked a supplementary question about what the white paper says, which says that actually the stabilisation oil fund would come from borrowing on the money markets. But you said in response to that, I think, Jim, that assumed no change to the licensing and tax regime, and that in your view, a different licensing and tax regime would free up revenues from oil and gas in order to set up the oil fund. So could I just be clear on that? What you're saying is that in your view, in order to create an oil fund, what an independent Scotland should do is increase the tax and other fiscal take from the oil and gas industry.
No, I was not saying that. I did not say that tax should be increased. What I was saying is that steps should be taken using licensing arrangements and potential tweaks to the tax system to increase the percentage of oil-related activity which took place in Scotland, and that it was the multiplier effects of that in Scotland's general economy which would increase the take via income tax, etc. I was specifically not saying that Scotland must or should increase the tax rate on oil.
Sorry, maybe I'm just being stupid here, but I'm not following that. Either we take more money out, either the revenues to government from the oil and gas are more or they're not. And I mean, surely the activity is going to depend on what, yes, would have to be agreed in terms of geographical share or population share, I understand that. But then also all efforts being put in to make sure we extract the maximum possible from reserves. Is that?
So one would want obviously to have a sensible taxation regime which maximised the level of oil-related investment and the number of fields that were exploited. But it's important that as much as possible, as reasonably possible, of the economic activity associated with the oil extraction occurs in Scotland. As I said, at present, we've got 80% of the hydrocarbon production, but only 45% of the jobs.
I see the point. Okay.
And I mean, okay. This is something which Norway managed to do quite successfully.
Okay, thanks for that.
Could I add to that, in that right now we get the labour wages here in the UK, and we get taxes. But in fact, there's about 20 billion leaves the country, or leaves Scotland entirely, which goes out in profits. Now, what we would like, if at all possible, is that we would encourage, as Ireland has done in other industries, to get more research and development in Scotland, and to get much more of the high quality productivity associated with research and development and labour in this country. It shouldn't be beyond.
Or indeed, as Norway has done by maintaining a majority stake in the oil company. But we're back to
that might
changing
be for
history, aren't we?
Yes, or it might be for future oil fields discovered.
Okay. When we had Margaret, you made a point earlier about the balance of the UK economy and it being over-dependent on the financial sector. Not long before that, Jim, you had said something quite similar, I think, when you were talking about, you were suggesting that we should not work on the assumption that the UK economy is not risk-free and is strong and secure. And you said, and I wrote it down, the UK is highly dependent on a grossly oversized financial sector. Now, I might agree with that, but I think the financial sector in the UK, and I don't know this figure for sure, but by memory it's about, what, 480% of GDP, the assets of the financial services sector. But for Scotland...
I can give you that figure,
well,
actually.
Okay, well, let me finish the point. For Scotland, the figure is 1,250%, which is significantly higher. So, well...
looking at the figure this morning in preparation for this, for this meeting, and the assets and liabilities of the UK financial sector are about 1,400% of UK GDP.
And ours is 1,250.
That figure is actually disputed, and I'm not giving an authoritative comment on that because it's not a figure I've looked at. But it depends how you count, you know, the various parts of RBS and Lloyds, etc. So, and I'm not giving an authoritative comment on that, but I can say that.
So your clarification is that, in your view, Scotland is less exposed to its financial services sector than the UK. I wonder if the other two panellists think that's true.
So, you know, having assets as a very high number of GDP is a good thing. We want to have those. It's the liabilities that are the bad thing, just to be clear.
Well, it depends on the nature.
Well, any asset. Just give me an asset and I'll be grateful, quite frankly. Yeah, anything. Assets are good. Liabilities, on the whole, are problematic, depending on what you use them for. So, the question is liabilities as a share of GDP. You can't add the assets and the liabilities together. So the liabilities as a share of GDP, the figures are, I believe, and I totally accept that there's a lot of questions about how some of these are estimated. I completely accept that. To understand which part of RBS's assets should count and so on, I don't think they're publicly available figures. It's very hard. I have looked through the RBS's RBS's public accounts and this sort of thing, annual report and accounts. It's very hard to find out what assets and liabilities are in various countries around the world, in different parts, different subsidiaries and so on and so forth. So it's a very difficult question. As far as the published figures are concerned, right? I mean, and I'm taking no liability for those. I think that the figure that Treasury has published is 1,250% bank assets or liabilities to GDP, because obviously the two sides of the balance sheet balance. You just don't add them together. So 1,250% is what the Treasury said. Is that the right number? I don't know. It's very, very hard to work out exactly, but it's a big number. I mean, it's probably not a low number. The UK, I think people say it's 400%, but I'm happy to be corrected. I think on current measures, most people estimate bank assets or liabilities are probably a higher share in Scotland than the rest of the UK. But again, it becomes very tricky when you start saying which legal entity for RBS and things like that. It becomes a very tricky number to get at. A much better measure, I think, is look at the contribution of the financial sectors to GDP and employment. That's a bit more robust, right? In the UK, it's about 13%. sorry, in the UK, it's about 14.5% of GDP. In Scotland, it's about 13%. In terms of employment, I think it's a bit higher in the UK than it is in the rest of the UK than it is in Scotland. But they're not a million miles apart. I think the message to conclude from this, because there's different ways of measuring the size of the financial sector, the exposure to the financial sectors in both north and south of the border is a big number. That's what I would conclude. Which one's bigger or smaller than the other depends what dimension you're using.
Joe?
Yeah, and I think I'm not going to argue the case about which is the right number. They're both large and both significant, and given Scotland's got a relatively less diverse economic base, it just makes it that bit more difficult to manage. And if you don't include it, and if you think Scotland's, one of the argument might be, well, the RBS will leave Scotland and be regulated by the Bank of England and the UK regulatory regime, what happens to Scotland's tax base and the numbers we're assuming for corporation tax revenue? So there's quite a lot to be unpacked in all of that. It's a big issue. It's not something we can wish away, and it's not something that's going to disappear overnight or to be dealt with quickly.
Okay. I'll leave Scotland.
No, but that was, sorry, convener, but that, I think Joe was referring to, that was the argument in Professor Young's paper, wasn't it? And,
correct.
And also Standard and Poor.
Correct.
Could I just make a couple of comments? I think you have to look beyond the banking sector, the financial sector as a whole, because a lot of the dodgy stuff that goes on is in the shadow banking sector and other places like that. And it's the whole financial sector, according to the UK, as being about 1,400% of GDP. I don't think you can take this view that assets are necessarily good things. I mean, to an amazing, I don't have the figure, but an amazing percentage of the pile of assets and liabilities for the UK financial sector as a whole relates to financial derivatives, which appear on both sides, both as an asset and as a liability. And interestingly, what you have in the UK, maybe in Scotland, but certainly in the UK, within the financial sector, what you might call their internal balance sheet, amounts to a huge pile of cars that have been built up where they owe each other, you know, assets, where they owe each other claims, say, on financial derivatives. And that's the sort of thing that can go horribly wrong all of a sudden. And the position is potentially even worse than that, because when you've got a financial derivative, what's measured in the accounts is how much you'd have to pay to be relieved of your liability under that derivative. Now, underlying that sort of net figure, there's a sort of notional asset and liability which could be many times larger. So if you were to measure financial derivatives, what one might say, properly in terms of the notional implicit underlying assets and liabilities, the figure would be much larger, very much larger than 14% of GDP as the size of the financial sector in the UK, but nobody knows how much larger. And nobody, frankly, has got to grips with the risks and even the proper measurement of the financial sector in the UK.
Okay, last one. And Gavin has really asked this question, but I felt the answer got a bit. The answer he received went off at a little bit of a tangent, so forgive me for, in a way, asking the same question again. It seems to me that the core of the discussion this morning has been about assets versus liabilities and what the basis then of negotiation of Scotland's share of debt would be following a yes vote. And we've heard about the possibility of swaps of oil for debt, or the possibility of compensation for the lack of an oil fund, or the 1979 referendum result, or I'm sure there are many other things from other grievances from history we could find to look for compensation. But the truth is, the Scottish Government's position is a straightforward one. They say monetary union in sterling, that's the asset they want, and if they don't get it, then they will walk away from the debt liability. They said that again this morning in the press. Can we just be clear that none of the panellists actually believe that it is correct to set sterling as an asset against our debt liability?
If you described that if there is not a monetary union with the rest of the UK, the way that's put out in the white paper, that the response to that would be to walk away from any obligations on the debt. I think
because at that point Scotland wouldn't have a share of the asset. That's quite important.
Because Scotland wouldn't have a share
because sterling is an asset. That's the Scottish Government's position, I think. Joe addresses that. in our paper directly.
Yeah, okay. So I was trying to reword the question, because if you're, what do you mean by sterling? If you want to have a population share of the outstanding sterling there, that's not very much money. I don't think anybody would have an issue with that.
Share of sterling in a currency union.
I mean, notes and coins called sterling. If you took out the notes and coins called sterling and said Scotland should have a population share of that, I really don't think anyone would have a problem with that. In fact, most of the Scottish notes and coins that are issued by the commercial... So this is why it's playing with words by the sterling use. A monetary union is about the use, the shared use, the common use of the central bank. The notes and coins, the sterling bit, is a very small part of that central bank. That's, the two issues get conflated, which is why I'm trying to be very careful with answering the question. I'm just trying to be careful with answering the question. So, would an independent Scotland have a reasonable claim to a population share of the outstanding sterling liabilities, the notes and coins out there? Absolutely yes. Should an independent Scotland have a reasonable claim that it has a right to have a population share of the Bank of England on an ongoing basis? I struggle to see how that is a right, because it's a right on the UK taxpayers. And to walk away, in my view, just to complete the parts of the question, to walk away, it's not a default, technically speaking. You have to be clear on the technical issues. To walk away from what most people, including the Scottish Government, have suggested is a responsible position to taking a fair and equitable share of the debt. To walk away from that, I think, would be an erroneous position, and I actually think it would be an irresponsible position. I've said this before. I think it would be an irresponsible position, and I think it would probably have quite interesting consequences if that were to be, in terms of how other countries would perceive this, and the credit rating agents would perceive this, and foreign investors would perceive this if this were to come about.
Margaret.
Given that the fundamental position that I think the Scottish Government should have been taking on behalf of the people of Scotland is that a fair and equitable share would be for us to receive compensation, then when you're actually involved with the rest of the United Kingdom, or the government of the rest of the United Kingdom, saying no to monetary union, then it is fair for a political group in Scotland to say gloves off, we will use whatever powers we have.
That was my question. My question was, do you believe currency is an asset you can set against debt liability? That's a different question.
I think currency is an asset.
The position you're saying.
I actually said it when I was talking earlier on, that it's an asset in the sense that either side can actually damage it tremendously. And Scotland has the ability to damage the currency, and the United Kingdom government hasn't taken that into account in its position, and it's beholden on it to do so.
Do you think currency is an asset?
Currency is an asset. Right. We look at it the other way. We do not at the minute have a separate currency. If we went for a separate currency right now, you would probably argue with me that it's not as good as the currency of the United Kingdom. Therefore, it has a value, because you've used a value judgment in your mind of the two separate currencies.
Yes, I mean, I don't think one can reduce this to any formulaic, to any formula. But I think that, and my own long-term position, I make no secret of it, I would like to see in the long term an independent Scottish currency. But in the short term, there will be negotiations. And in those negotiations, everything is on the table. And as I said before, I interpret the white paper position on debt as being, to my view, a mistaken initial negotiation position that we will offer this very reasonable offer on debt if we get played fair by in other respects. And as I said before, I think that is now off the table. It may come back on the table. But we are embarking upon negotiations, and there's no formula. It depends upon a whole lot of things, the respective power of on both sides in negotiation, and in that negotiation, the power of the Scottish negotiators would actually be very considerable.
Do you want to comment? Or?
I'll them to say that the sterling value lies behind the Bank of England and its reputation to pay its debts, and has done so since its inception. So that's the value, and to assume to continue to have some call on that, I think, is not for the Scottish Government of any nature to assume is a given, and currently the UK coalition members have said it's not on the table.
I'll just make a comment on that. I think the appeal to history can be misleading, because the value of sterling historically was the Navy and the Empire and the foremost industrial power in the world, in which Scotland played a full part. And those are not there now, and so the value of sterling is not as great as it was. And to regard it as being this great thing which is out there now is nonsensical.
Yes, I mean, Professor Young said there's only two explanations for the stance of the UK Government, which has shaped the current debate on Scotland's currency: either confused logic and inadequate economics, or a subterfuge to frighten Scottish citizens to vote against independence by raising the spectre of economic chaos. Immediately afterwards. John.
Thank you. Yes, well, to continue that kind of theme of the reputation or the value of sterling, I mean, I take the point, Professor Armstrong, you talk about the reputation of sterling, or more precisely, the reputation of the government and the central bank that lie behind it that's of value. I mean, I just wonder, is there not an issue in there too that actually, certainly from a Scottish point of view, the convenience of using sterling is an asset? Because if you didn't have that, there'd be exchange costs, for example, and the banks would make more profits. And on that same point of view, it's still a bit convenient for England, not as big an issue maybe for Scotland, but there's a kind of value in there as well?
Yes, I mean, certainly having two separate currencies, assuming two separate currencies distinct from pegging to sterling, there's dollarisation, and that isn't actually an issue for the rest of the UK. There's a separate currency, yes, that is an issue for the UK. But clearly, as Margaret has alluded to, if there's a possibility of Scotland not getting what it wants, and that they could damage the reputation, to my mind, that's what the Sir Nicholas Macpherson letter is effectively alluding to. It isn't actually the transactions cost issue, which I don't think anybody would disagree is not there. It is there, but it's the fact that a country who didn't want to make the monetary union work and be permanent causes the problem for the bigger country, which would be the rest of the UK, and it's that aspect of why a no formal monetary union appears to be taken off the table.
Now, the question of perceptions of other countries was raised as well, and I mean, my assumption would be that if there's an amicable agreement, whatever that agreement is, other countries will kind of be happy with that. And so there wouldn't really be a difference in perception if there's an amicable agreement between the two parts. And also, I assume that the less debt Scotland has, the better the perception of other countries and the world banking system. Is that correct?
Certainly, if it starts off with a lower debt, that makes it easier to argue it's got a fiscally sustainable economic backcloth. The issue for me around the monetary union, or the stability of it, is if you are establishing two separate countries whose aim is to have different fiscal outlooks, two different sets of tax regimes, that starts to call into question the sustainability of the fiscal and the monetary union that you're trying to put in place. And if you're then relying on the Bank of England or the UK Treasury to sign off on your fiscal policies, and that doesn't allow you to do the things you want to do, therein lies the inherent tension. And I think, again, that's the Macpherson line, which says it's not to say that you wouldn't want to make it work on day one, but you're automatically assuming you're going to have a different outlook in life, and that creates the tensions in the future. And given that we know that that tension is there, let's not start down that track.
Yeah, I could maybe come back to that point with the other witnesses. I just wonder if the other witnesses could comment on about the other countries' perceptions of Scotland. The point that if we agree with the rest of the UK as to how we're splitting up assets and liabilities, then other countries' perceptions would be perfectly okay. Does anyone disagree or?
I agree with you.
Yes.
I think if the rest of the UK and the Scottish Government said these negotiations have been held amicably and we both fully agree with the conclusions of them, I think that would put both countries in a very positive position.
I would put a caveat on that, which would be provided that the underlying deal was sound. If one side in the negotiation has been taken for a mug, and obviously taken for a mug, then it will not be regarded as being a sound agreement.
So, right, so by that logic, if Scotland got a kind of a very clever deal, then we'd go up in people's estimation.
Yes, markets are hard.
Yes.
Are hard-headed. I mean, a resource-rich country starting off with low debt, markets are probably going to look kindly upon it.
Okay. The idea then that there has to be how much fiscal agreement or how much similarity there has to be if there's a monetary union going forward. I mean, is there agreement on that? Because I understood that, for example, the Benelux countries had, or I think Belgium and Luxembourg specifically, had a currency union for quite a long time and were still allowed taxes to vary a bit. And the United States, I think there's quite a variation between different states. So is it just a question that there's not too much, there's not total flexibility, but there's still a certain amount of flexibility even within a monetary union?
Well, actually, our argument has always been, since when we were considering whether Scotland should join the Euro, and at that particular time, there was quite an interest in Scotland in joining the Euro, and our view was it was quite dangerous. And that was because with the monetary union being determined, there wasn't enough flexibility in fiscal policy to compensate if, in fact, a country's productivity or just the hand it had been dealt was not enough to bridge the gap with the other countries, that fiscal policy's flexibility would fill that gap. So, in fact, monetary policy to us is really important, and having some leeway with with monetary policy is really important. So, like Jim, I would feel that monetary policy with the UK in the long run is not a good idea. In fact, even in the 90s, when Eddie George came up to, when still alive, came up to Newcastle and was asked what he was doing about unemployment, his stance at that particular time was that the information, that the way in which they ruled the Bank of England and therefore and how they determined interest rates was a function of what was happening to inflation. It's only very recently that Carney has come out saying that he would look at employment as well. So,
United States, that you've got however many 50-odd states, and they've got different tax rates, they've got different unemployment problems.
Absolutely.
It is.
Because, I mean, if you look at, the important thing to look at in the United States is, first of all, what's happening in pork-barrel politics, and secondly, what's happening in migration. And, for example, in the 90s, there was a huge movement in Texas of, I think, 500,000 folk moved out. The United States allows for tremendous labour mobility and accepts it, which we might find a bit disturbing, just because we're a different culture.
Okay, but the dollar does basically work in the United States.
Yes, but there's so much going for it. I mean, the world superpower, they've got a surplus which they can, in normal times, they've got wealth which they can fling at the pork barrel politics to smooth the operation of the Union. And also, as Margaret said, they're willing to tolerate levels of internal migration on occasion that would be quite difficult in a more settled kind of country, or European-type country.
Dr. Armstrong, did you want to say something?
Yeah, I find some of this very surprising. In terms of the fiscal controls, I think your question was about monetary union fiscal controls. We're dealing with lots of unions here. So you've got political union, which is the issue of sovereignty, and you've got monetary union, currency union, fiscal union, and so on and so forth. And economic union, very importantly. Now, the issue is, does political union actually have primacy? Do the others require this thing to work? And what we saw in the white paper quite correctly, 100% correct, on page 111, it says, of course, in future, it will be up to the people of Scotland to decide whether the monetary union or another currency arrangement will be in its interest in the future. Absolutely correct. That's what sovereignty means. It means you choose. Completely correct. So you then require the other side to agree an agreement which you acknowledge can be broken, can be walked away from in the future. That's what breaking the political union or sovereignty implies. Okay, so political union is a pretty big part of this. Now, the whole point of having fiscal constraints is to try and put that thing back together again and tie you into behaving, or the other party behaving, to make it behave as if it was like a political union. Do you see?
Yes, I suppose my question is really, I'm wondering, you know, it seems to me that from other examples around the world, there's a bit of room for flexibility.
Okay, so in this, the Benelux example you came up with, there was a great example. There were no fiscal constraints. And there's a really interesting example, because you've got a country, Luxembourg, which is actually very small compared to Belgium. So you had this really big imbalance. And so Luxembourg had no effective say in monetary policy in the region. It had one person sitting in the bank, and from what people say, they couldn't win a vote because there's one of them. So they had no say in monetary policy. Fine. There was no fiscal limits put on Luxembourg. If it goes bust, Luxembourg's problem. Why would Belgium want to control this little country? It just clouded perceptions. So there's plenty of flexibility in that case. Well, it survived for a long time, and the Luxembourgers were very happy. You know, there's only one place in the world that's got bigger banking liabilities to GDP than the UK and the rest of it. It's Luxembourg's 2,000%. So, you know, careful. It's a particularly interesting case. So there was an example of a very small country basically tying itself to a very big, or a multiple times bigger country, and accepting its lack of control over these issues. Now, would that be the solution that people would want, say, for an independent Scotland, that it would tie itself into sterling, even if it had one seat on the Monetary Policy Committee? Let's just suppose, right? If you have one person representing Scotland, I presume you don't expect the others to behave neutrally. You say they'd represent the rest of the UK. That's an 8-to-1 majority each vote. So it's probably not a great deal of power in terms of setting monetary policy. Fiscal controls, well, it's not obvious at all you even need them. You know, Scotland, if it wants to do something, that's up to itself. In terms of the United States, what's so interesting is many of the states have non-borrowing statutes. Right? They have written statutes saying they will not borrow. They did this themselves. It's not enforced by the centre. They did it because they understand the importance of fiscal responsibility. And my bet is if independent Scotland were to go down this route, that maybe an independent Scotland would want to actually, on its own right, take that way of actually offering to markets its own self-discipline. So but the key is, do you force it on countries like they try to in Europe, or do you actually put the emphasis on them and say, we're not bailing you out, you go bust, that's your problem. And so it's up to you to put your own fiscal constraints on yourself, and for yourself to start behaving responsibly. So the United States has a political union that allows it to have a monetary union. Everything else is devolved, effectively. I mean, not quite, but, you know, a very large amount is devolved. That model seems to work very successfully there.
That's very helpful. I mean, something else you said in your paper was that more indebted countries prefer higher inflation. So an increase in debt in one member country will cause monetary authority to loosen policy across the union. Yeah. I mean, I think we've seen that historically, well, in my lifetime at least, that there was high inflation and obviously your debts kind of got devalued, which for some people was a good thing. I mean, is that a risk for the UK going forward, that a future UK government, with or without Scotland, would be tempted to encourage inflation in order to get the debt down?
Well, that argument is a particular argument about monetary unions. So, you know, if you think of the Eurozone, why do they have what was the Stability and Growth Pact, and now you're having this Euro Pact, which is even tougher, right? You're requiring governments to put into national laws balanced budget requirements. I mean, it's extremely tough what they're putting in place now. What was the point of that? The point of that is that if I'm a national government and I'm choosing the size of my deficit, the amount of debt, if I can actually have a bit of inflation to erode the real value of these, that's a good thing to me. Now, guess what? I go to the ECB and get to vote on inflation. Now, I'm only one vote, but I get a vote on inflation. And my higher inflation, the trouble is, it puts an externality on the next country. And so you start having these externalities or these knock-on effects on other countries. And so the whole point of the Eurozone is, in order to have a stable currency, you need to have stable government finances. To have stable government finances, you need to have responsible government finances. And in order to try and enforce those in the Eurozone, they therefore put very tough fiscal constraints on these countries. That's because they all have a vote on the ECB. In the case of the UK, what would happen if, say, an independent Scotland had one vote on it, so it's very hard to see how it influenced the monetary policy decision in that case, then the logic of putting constraints on another country goes away. And it'd be much more, well, what would independent Scotland like to do in terms of its constraints? So I think this is an argument against having fiscal constraints on independent Scotland.
If you look at it the other way, assuming there's a no vote and Scotland's not independent, so therefore are you saying that the UK has really no constraints on it at the moment? And I mean, given that the debt looks like it's going forward for a very long time, there will be a pressure or a temptation for future UK governments to have inflation.
So there's a trade-off. The key is the trade-off. So the good thing about creating inflation, or the good, inverted commas, the payoff for creating high inflation is you reduce the real value of your outstanding debts. The damaging thing is you reduce your real income. So you've got a trade-off. And as one political unit, I can make that decision within the best interests of the whole of my political unit. The question is, when I set my national government's debt limit, but I vote on a whole region's monetary policy, including other sovereign states, then it's a different thing, because I can affect your outcome. And what the point of political union is to align the debt decision with the inflation decision, so everybody's voting on the same thing, it's the same debt and it's the same inflation. Then the incentives are all correctly aligned. Once you start putting those in different places, it becomes a much more complex question where you can make the case in certain circumstances for having constraints, and other ones you can't. So it's a complex question. We're actually going to publish a paper about this next week, so hopefully that'll be clearer than I'm trying to explain at the moment.
Helpful. Thank you. Could I move on just again for clarification on the quantitative easing question? I'm not sure I've quite got my head around that, because there seemed to be a bit of disagreement as to the 375 billion. On the one hand, the argument seemed to be it was just like normal debt and it's just owed to somebody out there outside the public sector, and it's just to be treated as all the rest of the debt. And the other argument seemed to be, no, it's more of an internal adjustment and it shouldn't be treated like all the other debt. So, Mr. Cuthbert, maybe, I mean, why are you arguing that it's not like another debt?
Well, I mean, I think this comes in at least two different levels. One level that comes in is the interest paid on that debt. Now, the UK government is not paying interest on that debt at present, or it is, but it's immediately recycling back from the Bank of England to the Treasury. So here you have a form of debt which is not actually costing the UK government anything. So when in GERS, Scotland is attributed almost £1 billion for the debt interest on quantitatively eased debt, I would argue that that is overstating the fiscal deficit of Scotland. But the much...
Pin you down on that. So there's no interest payment kind of going outside, it's just going within the system.
That's right.
And that's because nobody outside kind of holds any debt.
Because George Osborne wrote to the Governor of the Bank of England and said, can I have the interest back on this quantitatively eased debt, and nabbed it back. So that's one very important issue as regards Scotland's immediate fiscal deficit as expressed in GERS, and what the implication that is rolling that forward. But much more important to my mind is the question of, will the theory apply? And the theory is that once the economy starts to recover, these certificates will be taken out of the drawer where they reside in the Bank of England and be sold back into the market and suck the liquidity out of the system, suck the money that was printed that was used to buy these things in the first place. And what we are arguing is that there are now very serious doubts as to whether that process will ever be undertaken. And I've given quotes from a very serious financial commentator who's saying that effectively the government has destroyed a third of its debt because it will never reverse quantitative easing. It will just presumably sit forever in these drawers with the maturity adjusted to be like war loan to go on forever. Now, if that's the
one was actually owed to real people out there.
It was owed. It was different because interest was paid on that. It was owed to real people, but it was never going to be repaid, and the burden of interest on it became trivial because of inflation. This is even worse because there is no interest paid on it. So it's just a bit of paper on which no interest is paid, which may or may not at some stage be taken out of its drawer in the Bank of England and sold back into the market. And not us, but other people are questioning whether that will ever be done. Because, in effect, the government has got away with the process. Confidence has not been destroyed by this. They've managed this process. Why ever reverse it? And as you start to reverse it, then you're getting into this business of the Haldane difficulty of popping the bond bubble. what happens when interest rates start to rise? As the reverse quantitative easing, the danger of a catastrophic rise in interest rate, collapse of house prices, collapse of all the zombie firms, etc.
I've got the main point, yes. I mean, Dr Armstrong, you don't entirely agree with this, because is your argument that you're saying that the debt really is outside the system, outside the public sector, just like other debt?
Correct. The only correction to say it's not entirely agree, totally disagree. I think this is wrong. And I think people should be clear that this is not the right way to do it. I think that's pretty clear. What has happened is the liability that was held in the private sector, called gilts, has been bought by the asset purchase facility. It's now owned by the asset purchase facility. The replacement asset owned in the private sector is called reserves on the Bank of England. Okay, so there's still this asset owned by the private sector. You haven't mugged the private sector. They still own this asset. They did have a gilt, now they have a reserve account in the bank.
The sector put an extra $375 billion into the UK. Is that what we're saying?
No. The private sector held £375 billion worth of gilts. It then sold those, and in exchange, it gave up that asset. It got this other nice asset called reserves at the Bank of England. Yeah, you still owe them.
Increase in the public debt.
All you did is swap one debt for another debt. And you still owe them that. And the idea that you can just pretend you don't owe them it, well, I don't know how you do that. I mean, perhaps you tell the banks they're about to lose, you'll forget the capital. So, can I just finish? So the one type of debt has been swapped for another type of debt.
Debt then, is it?
I didn't say it was extra debt.
Right. So when the $375 billion quantitative easing happened, that did not create extra debt?
No, they bought debt and they bought some liabilities back and issued another liability called the Bank of England, the reserve accounts of the Bank of England. And the reason why they tried to do it in the first place was because they thought, there were several reasons, but one perception was if you increase reserves in the banking system, that will make them more willing to lend money, right? You'd add to liquidity, much more liquid asset, that would help them lend money. Not that you've created $375 billion of different assets. That wasn't the idea. The idea was to become more liquid, and that would encourage banks to lend. Then, when that didn't happen, the sort of motive went to, well, perhaps we're forcing interest rates down. Maybe true, maybe not true. These are difficult things to work out. But that's not the same as you've sold $375 billion of extra assets at no cost. The arguments are, is it a liquidity preference change in the banking system, or perhaps you had an influence on long-term interest rates. That's been the benefit of it. But you've basically taken one debt that you've owed and give another debt that you have back. Can I just correct on this interest point? The interest payments, which I think was a mistake for the Chancellor to ask for this and said so at the time, but the interest payment is net of the loan from the APF to the Bank of England, first of all. And secondly, that goes into the public sector account, so it means the public sector borrowing requirement is lower, which is why I think they actually did it, makes the PSBR lower, which means they don't have to issue as much debt. So it's not as though this money is actually being put in the back pocket and actually it's a sneaky game. It is, in my view, was a wrong way to actually present fiscal accounts, but the money itself is still within government. That interest payment is within government. This liability was to the private sector. It was £375 of gilts, sorry, £375 billion of gilts. It's now £375 billion worth of bank or the equivalent level of bank reserves at the Bank of England.
I think we've taken that probably far enough. Maybe I shouldn't have raised it again, but I think I will go away and read about it and try and understand it better myself.
I'm more than happy to write.
But I appreciate both your answers on that point. Kind of one more.
It's normally described as printing money, and the reserve in the Bank of England is essentially cash.
Yes.
So effectively you've printed money and given it to the banks in exchange for some gilt-edged securities. And it was presented at the time.
I think we've had enough on this one. I think actually, sorry, you've both given me answers, which I appreciate. So thank you very much. And my final question. The whole question of interest rates that Scotland might have to pay, I mean, the suggestion is that to start with, after independence, we might have to pay a higher rate of interest than the UK is paying. However, we see other countries around Europe and elsewhere who are paying a lower rate of interest than the UK is. So would it just be the case that we had a temporary higher interest rate because people didn't know what Scotland was like, and then once they get to know that we're just the same as Denmark and Finland and all these places, Austria, then our interest rate would probably end up being lower than the UK's. Margaret, sorry?
Well, part of that is going to be a function of what debt we've got.
Yes.
The second thing is going to be a function of what assets we've got. And as far as that's concerned, if we still retain North Sea oil rather than handing it over as a debt swap to the rest of the UK, then we could actually be in a far better position as far as...
Purely objective, there's no subjective element to it?
Markets can't afford to be too subjective after the initial... Obviously, there's going to be subjectivity in the first bit. After that, markets are hard.
So, clearly, it depends on the future decisions taken, either by the UK or by the rest of the UK and independent Scotland. Of course it does. But there's one element which is very hard to reduce, and that is liquidity premium based on the size of bond markets. And small countries often have to pay a liquidity premium just by very nature of them being smaller. Let me give you an example. Network Rail, which is explicitly backed, their bonds are explicitly backed by the UK government. Okay? You would expect they trade at exactly the same interest rates as the UK government, would you not? They don't, because it's a much smaller market, and so it becomes illiquid. So we have to be, one of the irreducible factors here is that smaller countries, on the whole, taking everything else out of it, one of the factors is their bond markets tend to be smaller, less liquid, and there's a liquidity premium that has to be paid.
So you say smaller countries generally pay a higher rate of interest than bigger countries?
There's a liquidity premium. That's, you see, there's many factors that determine the interest rate you're going to pay, the amount of debt, your deficits, your inflation, etc., etc., etc. But one element, and only one element, is actually the size of your bond market, the liquidity, the extent to which it's easy to trade in and out of that without affecting prices. Smaller countries tend to have smaller bond markets, and that factor alone tends to argue in favour of higher interest rates. The other factors, it depends on the decisions made.
Because if smaller countries then on the whole had stronger economies than bigger countries, they would tend to have lower interest rates, but they pay a little bit extra, as you're saying, this premium. But that might not take them up as high as the big countries. Well,
so you're exactly right. So you have this premium that you have to pay, but they could be stronger on every other aspect. Lower debt, surpluses, everything else could be positive, and therefore they pay overall a lower interest rate because these pluses more than offset this negative. It's just this one factor they're pointing to. But based on our assessments, as I said, we came out with that 120 central point, 120 basis points, which we've gone through the methodology and repeated it because people have asked a lot of questions about it, and we're more than happy to represent the work because we've obviously had some new fiscal figures to take into account and so on, which should really be taken into account in them.
That's great, thanks very much. Cheers.
One wants to say something there, John. Which is that the Network Rail example is an interesting one, and part of the premium might be because of the utility pricing model, which effectively underpins the financial stream to Network Rail. And since that is a flawed model, I take it there's an element of risk in the bond price of Network Rail attaching to that.
Okay, well, thank you very much. That seems to have exhausted the questions from the committee. I'm sure the witnesses are pleased to say. I'm just, before we wind up, is there any further points that any of our guests wish to make today? No? Okay, well, thank you very much. I really appreciate the time you've devoted to the committee this morning. That's, sadly, for the committee, not the end of our agenda. We'll have a 90-second break in order to allow witnesses and the official report to leave, because the next section of the meeting will be in private.